increases. Matt, I'm pleased to say, joins us right now for more. Matt, welcome to the program. I shared a quote from NVIDIA a little bit earlier this morning. I'd like to read it again and get your thoughts on it. When they say that DeepSeek's work illustrates how new models can be created, leveraging widely available models and compute that is fully export control compliant, do you believe what you have seen is fully export control compliant?
I mean, it's really hard for me sitting here in Boston to say what resources DeepSeek used. Obviously, we've all seen the speculation that they had processors that weren't export compliant, that they were using processors that they had before the export restrictions went into place, and that the cost of their model was a whole lot more than $5 million.
That said, Matt, is there sort of a takeaway here that we really have changed the mentality and maybe companies won't be as investing as much in capital expenditures to build out AI because there is an example of how things could be done more efficiently going forward?
So I still stick by what I wrote, which is the question is, or the thought process is AI changes how technology works. And so if you think AI is going to enable a great new technology like autonomous driving, it's not that it's too expensive right now. It's that it doesn't have the capabilities. And so the investment you're putting into your data centers is to enable that technology. And you want to be first to that technology because we've seen time and time again, when you have leaders in technology, they tend to stay leaders. Microsoft, Google, Amazon, you can go down the list.
That said, Mark Benioff of Salesforce had a great quote. This is kind of classic in our industry. The pioneers are not the ones who end up being the victors. Matt, how much are we learning that some of the biggest gainers so far on the AI craze are not necessarily going to be the big gainers? Was this the Cisco moment for the likes of NVIDIA?
So the question then, I think, is, did we overbuild? So you look back to 2000, did we simply build too much infrastructure like we did back in 2000 and we'll never use it? I guess I would be surprised. I think that the difference is in 2000, we created the backbone, 1999, 1998, we created the backbone, the internet. The internet was working at that point. Again, with AI, we still haven't really realized what the benefits of AI are. So I think until we see, here's a great new chatbot, or here's a great new personal assistant, and I'm buying a new iPhone because it's changing my life with this personal assistant, I think until then, it's really hard to say that we've invested enough.
Well, where do you think we are now in the cycle? Is there a chance that it's overinvested?
I think there's a chance that next technology takes longer to show up. So we get to the end of this year and there isn't a breakthrough in autonomous driving. There isn't a breakthrough in a personal assistant. And so companies look and say, is that goal that we've been shooting for, is it really achievable the way that we're going about it? And people rethink that. And that's been the concern with NVIDIA last year, heading into this year, that at some point you can't justify the investment. But I don't think this changes that goal or the amount that people are willing to invest to get to that goal. Because again, if you create autonomous driving, the returns are amazing. It's kind of if you became dominant in the search market back in the early 2001 timeframe.
Well, you talk about the fact that in this intermediate term, if it is more efficient AI, like we're seeing from DeepSeek, that on the margins, we could see increased adoption. What does that mean? What does that look like?
Yeah, so if you think about AI, right, part of it is part of the question is the expense. So think about it in search, for instance. I think people have said a search on using AI is something like 10x a traditional Google search. So if all of a sudden I can bring the pricing down by 90%, then maybe I move my infrastructure from traditional search to AI search, and then moving forward beyond that. So I create this new app. Let's say it's again a personal assistant on my phone. If it's easier, if it costs less to support that app from a hardware perspective on my phone, then there'll be quicker adoption. In turn, it leads to a faster refresh cycle, more semiconductors getting sold. And so that's why I'd say in the intermediate term, lowering costs, we've seen it again and again, server virtualization, for instance, it leads to faster adoption.
Hey, Matt, I just want to squeeze this in. Does this not raise questions about valuations of some of these firms, though? Do we have to sort of readdress that just a little bit, even if you can be optimistic about the future?
I mean, I think the valuation question is always a fair question, and certainly markets have, particularly recently, fluctuated wildly. But no, again, I think the value of these firms is what we might be able to change in the future, not how much it costs to get there.
Matt, appreciate your time and your input, sir. Thank you. Matt Bryson there of Wedbush. NVIDIA right now positive by 4.5%. Some optimism there. Still a constructive view.
That essentially we haven't really, I mean, to his point, we haven't really seen the broadening out. And there is this theory that the more quickly you can broaden out, the more demand, suddenly you have a real valuation, and then it can keep growing, and that's what people are betting on. Of course, there still are people calling it a bubble.
If you had the choice of watching the news conference with Chairman Powell or listening to the call with Microsoft and Meta, what are you choosing?
Obviously, Jay Powell. Just kidding.
Microsoft
Or
and
not.
Meta.
Without a doubt, right? Without a doubt.
Kidding.
It's got to be. It's got to be. That's must-watch tomorrow.
I actually am curious about what Jay Powell's response is to some of these AI developments and how much that shifts their thinking about efficiency. How are they modeling out something that the market is saying is going to be transformative to the employment market and beyond at a time where they've been flipping and flopping?
That's why we've got special programming for you tomorrow on the Federal Reserve at 1:30 Eastern Time. It's a good try. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Scott Bessent has been confirmed as the next U.S. Treasury Secretary, winning a Senate vote 68-29. That includes support from 15 Democrats. The former hedge fund manager's policy objectives include 3% GDP growth and a 3 million barrel per day increase in U.S. oil production. Israeli Prime Minister Benjamin Netanyahu is planning to visit Washington next week to meet with President Trump. People familiar say Netanyahu wants to speak with Trump about maintaining the ceasefire in Gaza. Israeli media is reporting that Trump's Middle East envoy, Steve Witkoff, is expected to travel to Israel this week to discuss longer-term solutions to regional conflicts. GM shares, those are rising just about 0.7% in the pre-market. The U.S. automaker reported better than expected fourth quarter earnings. It also offered a profit outlook that topped Wall Street estimates thanks to improvement in the Chinese market. Its upbeat forecast, however, does not account for potential tariffs on Canada and Mexico. The company, though, assured investors that it has a, quote, playbook for that scenario. And that's your brief, John.
I'd love to know what that playbook looks like. Danny, thank you. What is that playbook if you come out with 25% tariffs on Mexico and Canada?
Run, hide,
Right.
cry,
Yeah.
maybe move.
Unless it's a carve-out.
Hopefully they reveal some of that playbook for us. Up next on the program, U.S. dominance under threat.
We came into 2025, and I think across the board, outlooks, the theme was US exceptionalism. We're at the end of January, and a lot of this has the potential of already being rewritten for 2025. I think there's a longer-term story where US exceptionalism can persist, probably not to such a significant degree.
That conversation up next. You're watching Bloomberg TV.
about artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of which using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Always on the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Expert analysis on that. Sure.
Don't miss Bloomberg's interview with the Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equity futures on the S&P bouncing back, not by much, only by a third of 1% on the S&P 500. In the bond market, yields down across the board, across the curve yesterday. Yields up this morning by 3 basis points. The 10-year back to 456.47. And for those of you following the move in NVIDIA off session highs, up by 4.5% so far this morning. Under surveillance this morning, US dominance under threat.
We came into 2025, and I think across the board, outlooks, the theme was US exceptionalism. We're at the end of January, and a lot of this has the potential of already being rewritten for 2025. It does really put bigger question marks around those valuations because it reminds investors that these companies are not completely immune. I think there's a longer term story where US exceptionalism can persist, probably not to such a significant degree. Global diversification has to be even more prominent in portfolios.
So here's the latest. Investors reassessing US AI dominance after Chinese startup DeepSeek's newest AI model triggered a sell-off in global equities. Max Kettner of HSBC saying yesterday was not a game changer, writing, when we look at the S&P 500 breadth, it has been quite positive. The equal weighted index went up yesterday, not down. We might also see more broadening of the market, not only of the index, but also of the AI theme to enablers and users. Max joins us now for more. Max, welcome to the show, sir. I want to pick up on that last point. We've talked a lot over the last year about chips, about data centers, about energy providers. Do we need to talk a little bit more about who will benefit, the adopters? Is that where you see the trade going now?
Yeah, I think so. I think when we look at the last year, or really a year and a half, there was a lot of question marks on the AI theme. And we talked to clients, for example, around the monetization of AI. Who can really make money of that? Well, number one, we have already, and we are already seeing, even on an index level, we're already starting to see, I think, some productivity gains, some efficiency gains. When we look across sectors in the S&P, there's a bunch of sectors already, very, very clearly deploying AI and clearly having some beneficial factors from that. But most importantly, I think we've always had sort of this feeling, okay, it's really NVIDIA or maybe 2-3 behemoths that really make money off this, but how are we going to make money with this on a broader scale? So I don't quite get the reaction from yesterday when people say, oh my goodness, it puts the whole year's exceptionalism case really under threat, because we've been moaning about it for really more than a year that, this is not a broad-based story, and actually across all the names, and it's highly questionable whether anyone can make money of that. Whereas what you're seeing now is, with that, if that really comes to fruition, that it is much, much cheaper, which again is actually still remains a heavy question mark behind that. But if that's a theme, then this is a game changer actually for sort of the broader sectors to put AI to a test and into practice and really get some gains from that. So it should then shift more to the AI enablers that clearly have been lagging the trade over the last 12, 15 months.
Max, you sound very optimistic, which is as I would expect, considering that you've been taking a good dose of Goldilocks on steroids. I am wondering, though, you talk about it might be a game changer, but it's not the game changer, and certainly not in a negative way with respect to tech. Tariffs, not a game changer. Immigration, the real game changer is disinflation. How do you separate out this idea of disinflation with growth from these other ideas that are whipsawing markets, whether it's tech advancement or whether it's tariffs?
Look, I think on the tech side, it really remains, or on the AI side specifically, I think it really remains to be seen whether that is that big game changer. And if anything, I think that's probably going to be something that we will see panning out in the next few years, not instantaneously in the next 3-6 months. The same thing is on tariffs. We don't know how that will pan out, if it comes, how it may come. Same thing on immigration, on any kind of really big immigration flows. Well, number one, we've already seen a peak in immigration flows in the second quarter last year, and ever since it's clearly gone down. So that and the inflationary impact on that, whether that is inflationary and how much that's going to be, I think that is much more a story for H2, possibly only for H1 2026, but certainly not for the next 3 to 6 months. Because Lisa, what you were saying, the story now is the disinflationary impact from things like super core inflation, from the underlying inflation measure from the Fed, and some of those insurance components that was sort of artificially inflating those inflation baskets at the beginning of last year. That now perhaps not repeating at least to the same magnitude like we've had it in the first quarter 2024 and first quarter 2023. I think that's the much bigger story, particularly from a timing perspective. So to your question, how do you separate them? I think people are sort of confusing the timelines a bit. What we're discussing about, tariffs, immigration, possibly
Max,
also
can I just jump in for
AI
a second? The president is talking about potentially tariffs as soon as this Saturday, if not a review by April 1st. Do you not take him seriously or literally?
No, I think a lot of it might be tactics, right? We've seen that possibly also last Sunday with Colombia, for example. So I don't think I think let's put it that way. I think the number one mistake that we can make, both on a portfolio basis, but even on just a trade by trade basis, is to trade off every single headline day by day, right? Otherwise, Sunday evening we would have said, ooh, really bad on EM currencies, really bad LATAM, and then 12 hours later you would have said, actually, scrap that, let's go the entirely opposite direction. I think you're really risking then flip-flopping around in terms of your views and really trade off every single headline rather than really trade the sort of bigger picture, the underlying inflation and growth picture, which again, to me, really is sort of outweighing those kind of headline risks that we're facing in the next 3-4 months.
Hey, Max, good to hear from you. Max Kettner there of HSBC. What did he call it? Goldilocks on steroids?
Yeah, he's taking a good dose of that this morning.
Big time. Up next on the programme, at a second hour of Bloomberg Surveillance, Sarah Hunt of Alpine Saxon Woods, Ed Mills of Raymond James, Greg Peters of PGIM, and a whole lot more from New York. This is Bloomberg.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent the Bitcoin on beer and groceries and gas and video games.
And
I wish I had kept it. I wish I would buy a Harley today if I had.
Yeah, but you probably wouldn't be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that
I'd
is.
be my feet in the sand and a beer in my hand.
Don't miss the next Open Interest.
To succeed in Wall Street, what skills do you need? You need to be somebody who claws people on the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Consensus is a little bit too optimistic about growth, a little bit too pessimistic around inflation.
I think we'll see a lot more volatility. That's going to give the Fed more time to pause.
I think that coming into this week, the Fed was already somewhat irrelevant because I think everyone knows that they're not going to cut rates.
They'll hold, and then President Trump will disparage them.
It's very possible that the Fed is going to have to take some of their cuts back this year because inflation is at best stuck at these levels right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
If you are just joining us, welcome to the program. The second hour of Bloomberg Surveillance starts right now with a small bounce. Maybe you were looking for more. We're only up by 0.2% on the S&P, on the Nasdaq 100 after yesterday's big sell-off, the biggest of the year so far. The Nasdaq 100 only up by 0.4%. Speaking of big sell-offs, $600 billion of market cap, almost that number lost on Nvidia yesterday, bouncing back by just 4% this morning. And I have to say, the bulls are still bullish on this name. Pick a firm. Cantor, saying we see this as progress, as a positive. Deutsche Bank, cheaper AI is likely to mean more AI. Wedbush, this is another golden buying opportunity and not the time to panic.
The reason why people are panicked is because it challenges the fundamental assumption that has driven so much of this rally, which is that any kind of AI advancement would come on the backs of huge investment in chip operators. And if you really undermine that, you undermine, as Rob Arnott said of Research Affiliates, the buffalo on the plain human beings herd. We do get influenced by the narratives around us. This is how bubbles take shape, and that fear seems to be still pervading the market.
Going back to Dan Ives' note, though, he's talking about in his entire, basically, history covering tech, he calls this an AI head fake. He says now is this means it's a buying opportunity. And then when you heard from the president yesterday, he was talking about the fact that this just means the U.S. needs to be even more laser focused. So almost, maybe it means the United States is going to double down when it comes to investing in this space and wanting to build it out.
Does it upend the CapEx narrative? To get there, you've got to believe that this was fully export control compliant. NVIDIA yesterday suggested it was, but when you speak to the analysts, they can't answer that question. They can't answer it. And I think that's one of the most important questions with regard to the moves we've seen in the past 24 hours.
They either can't answer it, or if they try to, they really dispute it. We're speaking with an analyst later this morning. You mentioned this, about from Bernstein, Stacey Raskin, who basically said, in short, we believe that DeepSeek did not build OpenAI for $5 million. Stop it already. It did take more. Still, there is this feeling that maybe people haven't woken up to the broader adoption story. Is this the beginning of that, which could be a positive for the rest of the S&P 493? And that seems to be what we saw yesterday.
Speaking of export controls and trade and tariffs and all that tension, we've got to talk about it. The dollar is stronger. The euro's weaker. Euro-dollar backing down to 104.21. Negative on the session by about 0.7%. Trade is very much on the agenda. I don't think it ever left. I think the president is doubling down in the last 24 hours.
You said it right. It hasn't left. It's just the matter of times that potentially he talks about it and adds a little bit more weight into what he plans to do. There was this report in the Financial Times that the newly confirmed Treasury Secretary, Scott Bessent, is talking about this gradual approach to tariffs, and Trump said, no, it's going to be much bigger than 2.5%. He says in his mind he has the number, but he's not ready to share it yet. I think what the market is trying to figure out is what is the number and when will we see them? Because at one point he was talking about this Saturday, this week, potentially tariffs levied on Canada, Mexico, and China, although in written writing, the EO calls for April 1st.
Honestly, it feels like kind of trying to hold water, and I kind of am trying to figure out exactly why markets are getting whipsawed, and I'm very much looking forward to the tech earnings, because I feel like you can hold on to that more than tariff proposals that keep whipsawing.
Meta and Microsoft, together with Tesla, coming up in the next 24 hours. 3 to watch, that's for sure. Some big earnings calls for those companies. Can they justify that big CapEx spend through the year ahead? I just keep going back to that quote from Google's Sundar Pichai from last summer. The risk here is under-investing and not over-investing. Will we get a challenge to that story over the next week or so? Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods, with stocks looking to make a comeback. We'll catch up with Ed Mills of Raymond James as President Trump calls China's DeepSeek a wake-up call, and Shah Pereza of Guggenheim as doubts creep in about the expansion of AI infrastructure. We begin this hour with stock steady, looking to bounce back after China's AI firm DeepSeek caused a shake-up in global equity markets, sparking concerns about sky-high tech valuations. Sarah Hunt of Alpine Saxon Woods saying there is an argument to be made that this is a healthy pullback. The projections on power and data center growth were already in question in terms of feasibility. Sarah joins us now for more. Sarah, it's good to see you.
Good morning.
Let's talk about all that energy stuff. Nat gas down yesterday, nat gas producers down yesterday, pipeline operators down yesterday, utility companies down yesterday. Would you jump in today?
So I think that was a little bit overdone, but there was a little bit of creep in terms of valuations in that group anyway. They're never going to get the same valuations as tech, but there was a lot built into, especially on the utility side, how much could happen because of the data centers. They're still going to get built. We still need power. Capacity in this country is constrained. We talk about things like brownouts over the summer and things all the time, regardless of needing the data centers, and the fact that you can't now locate data centers because you don't have the power. So to the extent that there is a possibility that we can use less power, that's not, in reality, I don't think, a bad thing.
A lot of people have made the argument this doesn't challenge the theme, it reinforces it. But do you believe that perceived value migrates elsewhere, beyond just, say, one single name, NVIDIA?
I think the biggest challenge is to NVIDIA, because obviously the shortages and the ASPs that they were able to get and everything else was driving a lot of that earnings and a lot of that stock price. So the question is, if I do need less chips, is that going to be a problem for them? I'm not sure that we know that yet. And to the extent that this is one of those, here's a bunch of things that we did without really understanding the back of that and what other language models they were using to help generate some of this, I'm not sure we know whether or not you really need less chips. I don't know that that's clear yet. Right now, we're still building some of those things, and we're not going to change that CapEx tomorrow on a dime because this story came out. So from a short-term perspective, I don't think it changes a lot. The question is from a longer-term perspective, and that CapEx build was part of what's been moving this market.
So I can think of a lot of things that I don't know, a lot of them, and things that I want to know more about. I don't know how much I can really understand what to buy, what's potentially bubble valuations. This is sort of the big debate. Is this just sort of a bump on the road to a greater efficiency and greater adoption, or is this really indicative of bubble-like mentality that's been baked into some of the top-flying AI names? How do you know? At what point will you know?
Well, I think what you saw yesterday, right, with the S&P equal weight doing better than the S&P, obviously, because the tech giants were the ones that were having the problem. I think that shows you that there's some air to come out of that, because people have been chasing it like it's going to grow to the sky. It's not going to go to the sky. We know that, but we don't know when that growth stops. And I'm not sure we know any more now than we did before, except that we've taken some of that premium valuation down a little bit. I mean, I look at the pipelines yesterday, and some of those pipelines got hit pretty hard. We like infrastructure on the energy side, but some of that was starting to creep up to valuations that was probably a little high. But I mean, if you look at the overall where the market started this year, valuations were high. So the idea that we can get a pullback in January early in the year is not a bad thing.
So what were you buying and what weren't you buying on the pullback? I think it's interesting that you go to pipelines, but you don't necessarily go to NVIDIA.
Well, so NVIDIA is a question that we just don't know enough about yet. We own some NVIDIA. This is all we know. We've been talking about the and all the time, right? You own the technology stocks and you own other things. You don't go all in on technology, because when you have days like this, it becomes somewhat frightful. But you have some in your portfolio. You're not necessarily always equal weight to the market. Sometimes you're underweight the market, and you don't go chasing it until you understand a little better why that just went down and where do you think you're going from here. We're seeing a pop this morning. It's not a huge pop. The market is looking like it's a little bit green, but not crazy green. I think that there's still some time for it to work through, and I don't think we know enough for it to answer that question yet.
This past week, we've challenged aggressively, really aggressively, consensus positioning coming into 2025. Yields lower, not higher. Dollar weaker, not stronger. And then tech starts to collapse as well. What do you make of that more broadly? Just how consensus was set up into 25 and the challenges to it in the early part of this year?
What's been interesting is that sort of starting off every year, we've ended up with a very different story by the end of the year than we did at the beginning of the year. So I think that there is that theme has been happening because stuff on the ground is moving really quickly. And something like this that upends a story for some period of time is part of that moving really quickly. I think we don't really know, just like we don't really know what's going to happen with tariffs. We don't really know where the administration is going to land on this. It makes it very difficult to have a theme that you can absolutely stick to and say, no matter what happens, I'm going to do X, because you don't know.
We've had 1 week of the Trump administration, and people have decided that maybe he's not that serious on trade. What would you say to those people?
I think he is serious, but I think that the way he's going to be serious about it is going to be in these loops where it starts off this way, it ends up that way. That's been a lot of what he does about different things that he's trying to do, which is, I'm going to put this crazy thing out there, and then I'm going to bring it back to something that you would have said was crazy, but because the crazier thing was out there, now this seems reasonable, right?
It's unpredictable by design.
Yeah,
so
yes.
But a lot of people in the market really kind of ignore it and say this is just a negotiating tactic. What do you say to that?
It's something is going to come, and it's going to come into sectors that we're not sure exactly how they're going to be affected, and it's going to be things that we're going to have to take into account. But if you end up with something like a 2.5 for most of the things and a this for that, as opposed to 25 or 30%, all of a sudden that becomes really manageable, and everyone goes, oh, that's not so bad, because we were throwing around numbers like 30 or 35 or 50. So I think that there is going to be some effect. We don't know what it's going to be yet, and we just have to attune ourselves to look for that.
So far, what the president has said, at least yesterday, is he knows in his mind what the number's going to be, and it's going to be more than 2.5%, at least based off this FT report. So, taking all that together, do you have a base case, or is that too dangerous?
You have a moving case. It is always a moving feast. You're trying to figure out what's going to happen and what's going to happen 6 months or 12 months down the road. Those stocks react very quickly, like they reacted yesterday to that story. I think that there are going to be places where it's much higher than 2.5%, but the idea that there might be a baseline and then some targeted areas is more easy for people to start to think about and model when we get that information. We don't have that information yet, but we know it's coming.
So there's a lot of unknown. We keep talking about it. I keep explaining how I know very little, and it feels like I'm in a black box where I'm just kind of trying to feel my way around, as I'm sure everybody else does. There was something instructive, though, about what we saw yesterday, which is that bonds acted as the relief mechanism, that they performed as they were supposed to in a downdraft. Is that a roadmap for what's to come, or do you think that that was sort of a one-off knee-jerk response that doesn't really tell us much about the trajectory of this year?
No, I think that was good news, and I think that to the extent that people have started to put bonds back in their portfolio because we have interest rates again, that is also good news. And for the government, that's good news because if yields come down a little bit, and then we've got an auction coming up, that's a good thing too. So I think that ballast, it should work that way. And we've had some correlations in the last couple of years that were very unusual. And so to see the correlations start to come back to something that makes a little bit more sense from a historic standpoint is not a bad thing.
From an allocation standpoint, can you rely on that being sort of back to normal for the rest of the year, especially given the uncertainty?
Oh, I'm not sure I know what normal is. And I think in the end, it's always you're looking at what's going to happen next. You're looking at what you think is going on, whether or not this story really takes the wind out of the sails of the equity market or it's a blip. then you think about where that allocation goes. But I'm not sure that you can cookie cutter anything right now.
Sarah, it's always good to see you. Thanks for your time. Sarah Hunt there at Vampire Saxon Woods. This move in equities is fading. On the S&P 500, we're only positive by not even 0.1% right now on the S&P. On NVIDIA, for those of you tracking that name, we do every single day, of course, that name is only up by 3.5%, Lisa. So this is not much of a bounce, and it's fading by the minute.
We haven't gotten much clarity. I mean, that's Sarah's point. If we don't have much clarity, how can people have the conviction that certainly we're not going to see more of the same, especially given that the washout still has potential legs if there is validity to this.
NVIDIA positive by 3.5% in the pre-market. With an update on stories elsewhere, with your Bloomberg brief, is Danny Berger. Hey, Danny.
Hey, John. UK Prime Minister Keir Starmer says the country's economy is starting to rebound. Speaking with Bloomberg's Francine Lacroix, Starmer said his Labour government is prioritizing growth. Starmer also spoke about a recent phone call with President Donald Trump.
There's a huge amount of trade between our two countries. I think that's to our great advantage. I think that's something that we can build on. And so I was very pleased with the engagement that we've had with President Trump. We'll build on that.
Chancellor of the Exchequer, Rachel Reeves, is due to give a speech tomorrow outlining the government's strategy for growth. And shares of JetBlue getting whipsawed this morning between gains and losses after the company reported fourth quarter earnings. The airline reported a loss per share of 21 cents, beating estimates for a loss of 31 cents. Operating revenue also came in slightly better than forecasts. Now, Google Maps users in the U.S. will soon notice a change. The Gulf of Mexico will be renamed the Gulf of America. The renaming will take place once government official sources are updated to reflect the change ordered by President Donald Trump last week. The Gulf of Mexico will remain in use in Mexican versions of Google Maps. International users will see both names displayed side by side. And that's your brief, John.
Danny, thank you. News that you can really use. I don't hate it.
Well, I checked it today. I was like, when is it going to be renamed?
You wanted to have a look?
It was still Gulf of Mexico.
Did you feel patriotic about it?
No, I think it's hilarious. I'm not hilarious. I think it's serious.
Up next on the program, an AI wake-up call.
The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser-focused on competing to win.
That conversation up next, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asia markets.
This move is not sticking. We're positive by not even 0.1% on the S&P 500. It's a small bounce. In the bond market, yields still just a little bit higher. Following yesterday's decline, yields up by 2 or 3 basis points, 456 on 10s, and the single name to watch, NVIDIA, bouncing back by just 3.5% after a big percentage point and market cap decline in yesterday's session. At the surveillance this morning, an AI wake-up call.
If it's fact and if it's true, and nobody really knows if it is, but I view that as a positive because you'll be doing that too, so you won't be spending as much and you'll get the same result, hopefully. The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser-focused on competing to win.
So here's the latest this morning. President Donald Trump addressing concerns about DeepSeek after the Chinese company's latest AI model rattled global markets. Ed Mills of Raymond James saying the following: DeepSeek's announcement places a spotlight on the effectiveness of U.S. tech export controls. President Trump ordered a review of export controls on his first day in office. We expect that review and the DeepSeek announcement to be a catalyst for further restrictions in 2025. Ed joins us now for more. Ed, welcome to the program. Let's go straight of all to that line from you. What further restrictions? What kind of restrictions, additional ones, would you expect?
So, John, in December and January, the Biden administration put out some new rules that will put country-by-country caps on some of the chips that are allowed from NVIDIA to go to those countries, to build up the data centers, to go into those LLMs. My expectation is that those rules could get tightened. There's a lot of questions I've gotten at Raymond James on whether or not Donald Trump was going to overturn those rules. I don't think that's going to happen. And then you look in his administration, you have Marco Rubio, you have Mike Walls, hawkish individuals on China. Do those rules say there's certain semi-cap equipment that could make chips that are less than what NVIDIA can do? Some things that went into DeepSeek, do we see those chips or that semi-cap equipment not go into China because the U.S. government does not want China to have the ability to make them and build out other models?
When it comes to trade and tariffs, are chips now going to also be used as a chip, a negotiating leverage as well?
Absolutely, Anne-Marie, and that's something we've been saying, is that the rules that were written by Biden, in many ways, we thought those were things that were written with Donald Trump in mind. To the extent there are country-by-country caps, to be able to have Donald Trump come in and say, all right, do you want that cap to go up? Do you want that cap to go down? What are you going to do for me on trade? When it comes to China, this is going to be front and foremost in a lot of those trade negotiations. Donald Trump wants China to adhere to their phase 1 trade deal that he inked back in 2020. He's going to add certain kind of restrictions on semi-cap equipment that they also want today on whether or not he decides to put in a tariff or ease up on those tariffs.
But Ed, what do you make of the fact that the hot rhetoric coming out of the Oval Office at the moment has been really about other countries, less so China, more about Canada, Mexico, this weekend Colombia, and he's sort of been a little bit more reserved when it comes to Beijing?
Anne-Marie, I think that the kind of things that I hear from folks in and around Donald Trump is just because you didn't hear it day one doesn't mean it's not really important. I do think that he feels as if he has a baseline of tariffs that he put in that were maintained with China that gives him a little bit more flexibility. He's looking to see what he can get from other countries where he has arguably even more leverage than it has with China. So here at Raymond James, we're telling folks, do not sleep on the fact that we could get universal tariffs, plus these country-specific tariffs, plus a trade fight with China. When we survey clients, most of them tell us it's not going to happen. I think that's a mistake.
Why do you think clients in the market are so overboard, basically, one side of the boat when it comes to this is really just negotiating? He's not going to pull the trigger.
I think because they think there's a Trump put on the market, Anne-Marie. I think there is a view that Donald Trump views the equity markets in particular as a barometer of success. And we've seen a little bit of crying wolf so far. We look at what happened with Colombia, and the takeaway there is if he uses the economic power of the United States, the other country is going to back down. That is probably true in the near term, but as I look through the year, I think by mid-year, we're going to have a whole bunch more tariffs on board that we have not today. And I think then what the market is thinking is once those tariffs are on, that's when Trump, the deal maker, starts. And I think finally, Anne-Marie, there's other parts of the economic agenda that they think are potentially positive. We're talking about extension of tax cuts, deregulation, more incentives to make things in the United States. So it's a balance, but I do think they underappreciate kind of the tariff risk near term.
As we try to see and have to wait to really understand what the tariff risk looks like, people are trying to understand what the framework is that the Trump administration is using to achieve some of the goals that he's talking about. When it comes to tech dominance, I wonder how you dovetail that with immigration policy. I was looking at a government study that showed that foreign-born workers made up about 20% of the tech workforce in the United States. When you look at advanced degree holders, it's significantly higher. I'm just wondering, are we hearing anything about constructive immigration reform at a time where we are seeing the images of the deportations, the mass deportations that Donald Trump promised?
So, Lisa, you're bringing up the argument that got Vivek Ramaswamy kicked out of DOGE. There is a desire among a number of the folks within the tech industry, especially those who are very close to Donald Trump, who say, let's do something about expanding out H-1B visas. As you are dealing with illegal immigration, let's do more on legal immigration. The problem for that is when there was a conversation brought up about expanding H-1B or reforming H-1B, the base of Donald Trump and a number of the elected officials who are in charge of changing immigration policy in Washington, D.C., came out adamantly opposed to that. Is it possible? Maybe. But I think what they're thinking right now is that they're focused on kind of the near-term goals of Donald Trump to say there is an increase in deportation of individuals who are in the country without documents who have committed crimes. I think they would say there's a long way between that and impacting the tech industry, which has relied upon a lot of non-U.S. citizens with high tech degrees to have that U.S. dominance.
This raises an interesting and important point, Ed. Are we learning something about where the gravitational force is going to be for at least the remainder of this year in terms of which voices are going to get most heard in Donald Trump's Oval Office?
It's a combination. I think when we look at emergency powers and executive action, tech is absolutely going to be at or near the forefront. They had a seat at inauguration in front of the cabinet. That was not by accident. But when we look to Capitol Hill, when margins are so small, there will always be individuals who are unwilling to vote for a bill. And so that's where they need to keep that coalition together. They need to pass the Trump agenda with only Republican votes. You can only lose one or two of them. So you're not going to upset the voices on Capitol Hill until that agenda is completed, extending out the Trump tax cuts, getting something on immigration for funding of the wall, getting something on defense spending, getting something on energy permitting reform. That's their priority near term.
Ed Mills, appreciate it, sir. Ed Mills there of Raymond James. Speaking of inauguration and the attendees, did you notice that the TikTok boss was alongside the nominee for Director of National Intelligence, Tulsi Gabbard?
Yeah, I mean, you'd have to think like how awkward potentially that conversation might be.
If we're worried about TikTok, shouldn't we be worried about DeepSeek in the last 24 hours? That was the conversation that we had with Peter Chi of Academy a little bit earlier this morning.
Yeah, which is the reason why I think that you saw some real questions around capacity. Didn't it shut down yesterday? It was the subject of a lot of attacks, and then people are saying, no one's going to actually use this. I will just say, you say awkward between TikTok's CEO and Tulsi Gabbard. What if it wasn't? What if it was like, yeah, it's just images going through with kids?
That's what it is? Yeah, maybe. If you are just joining us, you're probably looking for a bounce. You're not getting one. On the S&P, we're up by not even 0.1%. We'll catch up with Shah Pereza of Guggenheim as China's DeepSeek prompts doubts about U.S. AI infrastructure.
is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Anne-Marie's birthday coming up.
I knew that was happening.
Happy
You are
birthday,
such a
Anne-Marie.
brat. Age of Aquarius.
Okay, what's wrong with it being your birthday? What's the problem?
I think it should be celebrated.
Everyone thinks it's your birthday now.
You know
Now
what?
we've
Happy
said that.
birthday. You should really take some time to enjoy
Happy
your
birthday.
day.
Happy birthday. Equity futures, it's not her birthday yet. Equity futures on the S&P just about unchanged. We're not getting that bounce. It's not coming through. On the Nasdaq 100, higher by not even 1/10%. We'll get you some single names as well with 2 hours until the opening bell. Your morning movers with Manus Cranny. Good morning, Manus.
Jonathan, you'll be able to look back in history and go, where were you on the day that $589 billion was wiped off the value of NVIDIA? You were chatting to me. $200 billion bounce back, but will it last? We had Plurimi Wealth this morning with Patrick Armstrong saying the question you now must ask yourself is the margins. How much of the margin dissipation is going to be recalculated here? By the way, he was brave. He's writing 110 put options above this. So he's writing premium. It's overdone. It's too aggressive. You've got to accelerate the timeline to competition and to margins. Right now, you've got a $200 billion bounce back. The energy factor, 97% less energy per query. That was the narrative from DeepSeek yesterday. And this stock was destroyed, down 28%. Jeffrey say, some of the assumptions, AI is going to be 75% of the overall U.S. power demand. I'm going to say that again. 75% of the increase in power demand here in the United States of America was theoretically down to AI. Do you adjust that? That nirvana of the data center build-out, the gargantuan estimates, do you need to reappraise those? What will you hear from the hyperscalers this week as they want to maintain their hold on this market? GM, the numbers come across the tape. Strong guidance with a murky EV outlook. That's the view from Dan Ives. He's got a $60 target on this. But the bottom line is the guidance. The guidance from GM is, look, we're going to make between 13.7 to 15.7 for this year. That's up on 2024, but they've not accounted for the risk of tariffs of 25% on Canada, on Mexico. They've got a playbook for tariffs, but you know, what is the big risk here? The risk here is, of course, carve-outs and tariffs. It's like a, you know, the old barbell. Jonathan, good morning.
Good morning. Are you going to wish Anne-Marie a happy birthday?
Oh, come on.
She'd be lucky if I don't sing happy birthday to her later.
Yes. Let's make that song.
It's not my birthday yet. It's ridiculous.
Getting closer though, aren't we? Under surveillance this morning, NVIDIA looking to recover after yesterday's 17% plunge sparked by worries over China's DeepSeek. NVIDIA erasing $589 billion from its market cap, the biggest drop in market history, eclipsing a previous record also set by the chip giant.
So at a certain point, this tells us more about how overpositioned people were to NVIDIA being the big winner going forward in perpetuity, regardless of the fact that we eventually were supposed to broaden out. I'm actually more curious to answer some of the questions that we've been asking. How realistic was it that DeepSeek truly was financed by $5 million? Did they use the subpar non-Blackwell chips, or did they use something else? And then number three, how adaptable are some of the U.S. companies to this technology that increases the efficiency on a both energy front as well as chip usage?
Well, NVIDIA put out a statement to try to answer at least one of those, saying their work illustrates how models can be created leveraging widely available models and compute that is fully export control compliant. But of course, I think a lot of people are saying, well, this is China. Do we really know what's going on behind the doors? What is going on in terms of where the funding is coming from? Is the CCP just pouring money into things like DeepSeek? In 2 weeks, in 6 months, can we see another version of this? And how are they being built?
If they have done this with a whole lot less and achieved a whole lot more, it's tremendously impressive and it upends a lot of assumptions. And you're going to have a lot of people ask questions about spend this week, CapEx from the big players. This came from Deutsche Bank, just in terms of the numbers. The 4 leading hyperscalers, Amazon, Microsoft, Alphabet, Meta, expected to surpass around $200 billion in AI CapEx over the course of the past year. Phenomenal numbers.
And most of it has gone to building out some of these data centers and acquiring Blackwell chips on pre-order because they haven't been able to make them fast enough over at NVIDIA. Do they retrench with their spending, or do they redirect it to new efforts that have other beneficiaries? And those are some of the questions that we'll be looking for.
That's the only one headwind, not the only one headwind that we're facing at the moment. Trade a big factor as well this morning. The dollar is a whole lot stronger against the euro, as the president says he wants to implement across-the-board tariffs much bigger than 2.5%. Telling reporters, quote, "I have it in my mind that it's going to be, but I won't be setting it just yet. But it'll be enough to protect our country. One thing we do know, it'll be more than 2.5%.
It'll be more than 2.5%, he said to reporters yesterday when they were asking about this report from the FT that is talking about the fact that Bessent is the new Treasury Secretary, pushing for this kind of system. It had brought me back to the debate where Trump said, I have concepts of a plan, concepts of an idea of how he wants to do this. The Wall Street Journal is saying that momentum is growing for them to levy these tariffs on Canada, Mexico, as soon as Saturday. So a lot of people are wondering, is this administration going to wait for the April 1st review? That was the executive order. Or are they going to maybe match what the president said verbally last week, his first week in office, saying maybe February 1st you'll start to see some of those tariffs? The Wall Street Journal says that's potentially what they're working towards at this moment.
What it highlights to me is just the level of uncertainty that keeps getting implemented at a time where we're wondering what the tariff policies are. There's some pretty big policy changes going on in Washington, D.C., having to do with funding being withdrawn, paused, things with respect to career employees and where they're going to go. And I think right now, how do you decipher the signal from the noise at a time when it's pretty noisy?
And maybe some big deals on the horizon as well. The president also mentioning that Microsoft is in talks to acquire the US arm of TikTok. The tech giant was previously in the running alongside Oracle to acquire the Chinese-owned app back in 2020 when Trump proposed a ban during his first term. What a ride we've had since then.
It seems like Satya Nadella had his seat in Mar-a-Lago that made him more amenable in terms of the tie-up. Interesting that X is no longer necessarily the dominant player here. But this, to me, highlights something that we did hear at Davos from someone who does invest heavily in TikTok, which is they think that a deal will get done and that probably it will stay operational in the United States.
Well, it's interesting you mentioned that and you say X, because what happens to the fact that our own reporting is saying that China, which has to sign off on this divestment, is saying they would like maybe Elon Musk to be the individual that shepherds this company through. They have mentioned no other individual. What I will say is Trump also said yesterday, I like bidding wars because you make your best deal. So if there's a bidding war, that's a good thing. So I think he's going to allow everyone to call him and allow everyone to throw their name in the ring when it comes to TikTok.
So the Microsoft call is going to be 1/3 on the earnings, 1/3 on DeepSeek, and 1/3 on TikTok. I mean, you can mix up the percentages if you want, but they seem to be the three big stories going into the print.
Don't miss that after the bell tomorrow, when no one's going to be talking about the Federal Reserve anymore, even though the decision happened just a couple hours earlier.
A lot of people de-emphasize that Fed decision. We've barely talked about it now for days.
I know, because what are they going to say? What kind of guidance are they going to give?
Isn't that good news for Chairman Powell there?
It could be.
Just that we've lowered the bar for him.
It also raises the question of a surprise, especially at a time where even if he does nothing, he will invoke the ire of the sitting president.
It lowers the bar until the sitting president comes out and says there was just a Fed decision. Why didn't he cut interest rates?
In the news conference, so the journalists can ask the questions, which would be perfect. Great TV. Maybe not perfect for the Federal Reserve, but great TV. If you are just joining us, equity futures positive by around about 0.1%. Let's turn back to DeepSeek's market impact of the last 24 hours. Losses extending beyond AI and chip giants as global investors reassess the sustainability of seemingly endless spending in the sector. AI infrastructure companies, including Constellation Energy and Vistra, taking a hit during yesterday's market turmoil. For more on that, we're joined by Shah Pureza of Guggenheim. Shah, welcome to the program, sir. I just want to understand from your perspective how you reacted to the news of not just yesterday, but of the past week or so, and whether it upends your thesis for 2025.
No, well, thanks for having me on. But to be honest, we believe yesterday's reaction in the news over the weekend was certainly a knee-jerk reaction in the utility and power space. One of the things we've been highlighting to investors and clients is that this is some of the strongest power demand environment we have seen in over 20 years of covering the space. The U.S. is essentially decoupling from China. In our view, and we don't quite agree with our competitors, 10 to 13% of power demand today is coming from AI on average. That's nationally. So everywhere you look, the demands for energy and power continue to grow. It's a super cycle. It's structural. So whether you're looking at the domestic manufacturing space, whether you're looking at the onshoring and reshoring of the manufacturing sector, the electrification of the system, Trump's big focus is on energy policy. That's LNG, petrochemicals, chlor-alkali. Anywhere you look, even this energy revival is going to push power demand materially higher. Industrial growth is extremely healthy, and that's the key driver of infrastructure needs.
Yeah.
So we believe yesterday's sell-off was well overdone.
Shar, within your points there, I think there is an interesting nugget, which is something that people have been talking about, which if you had the build-out and the pace of the build-out of AI with the current capacity for the next 5 years, there is no way that the energy infrastructure, even with additions, could support that. Can you give us a sense of just, even if you did reduce the energy demand significantly going forward of AI adoption, how you still would have to increase dramatically some of the energy production in the United States and globally?
Yeah, I mean, I think that's a very fair point you're bringing up. U.S. infrastructure has not kept up with the demand. When you sort of think about electricity consumption for the past 15 years, it's been a decelerating commodity with energy efficiency and demand side management. And then out of nowhere, there's this energy revival, there's this industrial revival, and the infrastructure in the U.S. has not kept up with the demand needs. And this is why many of the utilities, the power companies, the ones that we cover, are building a massive amount of transmission system. They're building generation. We've seen the retirement of coal assets get delayed because of this very tight power supply demand environment. So long and short of it is infrastructure has not kept up with the demands, and we do not believe the news around DeepSeek is going to impact any of those fundamentals.
That said, Shar, I guess that one of the potential headwinds to the entire energy sector is just that commodities are actually getting cheaper. When it comes to oil prices, they've been going down. People are getting more efficient at producing a lot of energy. How do you dovetail that into your optimism at a time where we see the actual commodity prices coming down for a whole host of different reasons?
Well, the commodity coming down is necessarily not a bad thing for the consumer, correct? So one of the arguments is to meet the needs of U.S. infrastructure, small modular reactors, likely not a viable option, large scale nuclear, likely not a viable option. You're not building any more coal plants, offshore wind's having a lot of hindrances. So really what's going to satisfy the needs in the near term as a bridge to another technology is natural gas. So the more the commodity curves come down, the more it becomes economical to build the infrastructure that's needed to meet the power demands. So in our viewpoint, the drop in the commodity, the drop in natural gas, which is deconsolidated from utility spending to begin with, is a very big driver for spending needs, and it's very pro-consumer friendly.
Is there a line in the sand, though, where it's good for the consumer, but it still makes sense for companies to go out, create new utilities to make sure that they can drill and get these products to market without losing money?
Well, I think, the barriers to entry to get into the utility industry, it's one of the most capital intensive industries there is. So there is a barrier to entry to get in there. I think the point we're just trying to bring up is talking to many of these hyperscalers that you kind of mentioned, talking to the utilities, there's a need for speed to market, right? Because as Microsoft told us, specifically on a client call, we're in a race to beat China. We're in the race to beat the 3 to 4 hyperscalers. We are not going to pull back spending, right? So the point is the amount of spending that is happening on U.S. infrastructure, whether it's AI, whether it's on the energy space, whether it's industrial, manufacturing, et cetera, has to be met with a generation source, right? And so there's a lot of money being put into it. I think natural gas is clearly the fuel, the bridge fuel to meet those needs, which is why there's so much investment going into the natural gas space. This is why one of the largest renewable developers in the country, NextEra Energy, did a GE deal to build gas. This is why Constellation Energy, the biggest nuclear operator, acquired Calpine, the biggest gas operator in the country. I think the shifts from decarbonization to resiliency and reliability are starting to take shape, because I agree with you that as you're looking at the demand outlook, the infrastructure has not been able to keep up with it.
Shar, how much excitement is driven by politics? Because, of course, Trump just last week lifted the permitting freeze that we had on LNG applications that were put under the Biden administration.
Yeah, I mean, I think politics is certainly part of it. I think under the Trump administration, we have a viewpoint that it's really good for energy, right? So when you're thinking about carbon rules for natural gas, when you're thinking about pipelines, when you're thinking about the LNG markets, there's clearly going to be a push to drill, and the focus is becoming energy sort of independent. And so part of this is policy, but to be honest, like even before the Trump administration took the helm, our viewpoint is the demand picture wasn't going away. There's such a big focus on shifting manufacturing back to the U.S. There's such a big focus around electrification of the system. All that is very much pulls on demand, and that is before even the Trump administration took the helm. Now, post-Trump, it sort of adds a lot of additional drivers to it, which is like what you've highlighted. There's going to be a major ease around the energy infrastructure business, permitting, et cetera. Again, all this that you're highlighting is going to push power demand growth higher. It's going to prompt these utilities to build the infrastructure to meet the needs.
Hey, Shah, appreciate your input and your opinion. Thank you, sir. Shah Pereza there of Guggenheim. The latest on some of the energy players, including the likes of Constellation Energy. Constellation last year up by 91%. Yesterday, Lisa hammered, down by close to 21.
It's the whole idea of the unraveling of a thesis that seems to have driven up a lot of utilities in addition to NVIDIA and some of the other AI players. At what point do we get clarity around how to understand valuations in terms of energy needs and how quickly AI will be spread?
Many of these guys aren't throwing the towel in, that's for sure. Equity futures on the S&P, positive by a little more than 1/10%, with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Trump says that he wants to enact across-the-board tariffs that are, quote, much bigger than 2.5%. Those comments after the FT reported that Treasury Secretary Scott Bessent is backing universal tariffs on U.S. imports starting at 2.5%. The president pledged tariffs on sectors including semis, pharma, steel, copper, and aluminum. Boeing shares are treading water, up 0.4%. They reported its 6th consecutive annual loss. CEO Kelly Ortberg saying that he will set in motion a portfolio overhaul after the company reported a deeply unprofitable quarter. The airline manufacturer noted that the 737 program resumed production in the quarter with plans to gradually increase its production rate. Coca-Cola recalling a range of soft drinks in Europe over higher levels of chemical chlorate. The company's bottling partner said cans and bottles impacted have been distributed in Belgium, the Netherlands, the UK, Germany, France, and Luxembourg since November. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on a program, higher for longer.
The 10-year is not priced for a higher for longer, structurally higher for longer inflation. It's still very much priced for kind of a 2% world.
The conversation up next, live from New York City. You're watching Bloomberg TV.
you've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice, my conversation, my poetry, you know.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Biggest one-day loss of the year on the Nasdaq 100, and not much of a bounce back on the S&P 500, higher here by 0.1%. Yields declining through yesterday's session. Yields up today by 2 basis points. The 10-year 4.5586. And the surveillance this morning higher for longer.
It's very possible that the Fed is going to have to take some of their cuts back this year because inflation is at best stuck at these levels right now, which means the 10-year is not priced for a higher for longer, structurally higher for longer inflation. It's still very much priced for kind of a 2% world.
Investors turning their attention to the Fed's two-day meeting, which kicks off a little bit later this morning when they wake up in Washington, D.C. Greg Peters of PGIM joins us now for more. It's 7:50.
Oh, the
That's
shade.
Not being rude.
The shade.
7:50.
Yeah, but they stay out till really late. They don't go to bed at 6.
Greg, welcome to the program. Isn't throwing shade at the FOMC. Greg, I want to go back to that quote that came from Oksana Aronovich of JP Morgan. When Oksana said, we are still very much priced for a 2% world. Do you agree with that, and should we be?
Yes and no. I mean, there's been a pretty radical shift in pricing of the tails. If you look at kind of the option pricing, you have a 30% probability of a rate hike, this year. That's much higher than where we were before. I think it's a worry, but I think the markets are reasonably priced today. Last year, I couldn't say the same thing when, if you recall, this time last year, rate cuts were all the rage, and investors were pricing in quietly 50 in March of last year. So I think we're much more reasonably priced today. I think the tails are representative of kind of the balance of risks, from an option standpoint. So, yeah, I'm not sure I totally agree with that statement.
There's a 0% chance of any kind of movement whatsoever at the meeting tomorrow that the Fed is currently engaged in. Do you still care about it?
Well, it's still only January, right? And so I think we're all hyped up in the first week, post-election, post-inauguration. And so we have a lot of runway. I think what investors are focused on is that the runway is shortening. And so I'm a little less concerned about that as well, but I'm not expecting much from this meeting just because there's so much in flux. I think that's the challenge for Fed officials. That's the challenge for investors, is that there's so much on the come. There's so much uncertainty, and it's going to be a long road ahead.
Given that, Greg, how do you get an edge? How do you have a thesis that you can actually, have any conviction with to say buy longer-term bonds, hand in fist, simply because you do think that inflation is going to come down with a backdrop that is so highly uncertain?
Yeah, I think you have to react to the action not their rhetoric. I think you have to take a longer-term view. Our longer-term view is that there is value in the bond market. Honestly, I'm somewhat indifferent as to whether bond yields rally or not. I really like the carry component of bonds. I think that's the story. That's what bonds are supposed to provide. I think many forgot that in the zero interest rate world. But you got a preview yesterday, and while I didn't necessarily agree with the price action, what you see is that flight to safety is really beneficial in a balanced portfolio. So what I think bonds provide you, treasury bonds provide you, is that protective measure. And with valuations as stretched as they are, I think bonds really do their job.
Greg, which piece of the price action did you not agree with?
Well, if you just kind of unpack, yesterday's price action around, AI, AI for the masses, whether you like it coming out of China or not, all else equal, is stimulative from an economic standpoint. So I would have expected real rates, if anything, to move higher, bond yields move higher, but there was just flight to quality mechanism. So, the sell-off was really, really narrow, but the bond market, I think, should have been more reflective of what we saw coming out from a data perspective. We got, reasonably positive data news from, new home sales and Dallas manufacturing, and that was kind of cast aside. So follow the data. I think is the real message here.
Greg, just to follow up and make it really simple then, you believe that maybe the risk aversion distorted the move in fixed income that we otherwise would have seen? That there's an argument here for higher bond yields off the back of the data?
Yes, exactly. So if you look at the credit markets were unaffected. It was it was literally a non-event. So all of the movement was in the Treasury market. And if you just take the data on balance, that suggests all else equal, higher, not lower bond yield. But it was a risk aversion trade that really won the day.
Greg, appreciate it. Thank you, sir. Greg Peters there of PGIM Fixed Income. Interesting final point there on the bond market. That
essentially, if you looked at the data, otherwise you would have had a sell-off with yields higher, and that the risk aversion around the potential sell-off of NVIDIA he sees as being misguided because essentially greater efficiency will lead to greater productivity, which will lead to faster growth, which potentially should send yields higher.
Good news for Chairman Powell tomorrow, no forecasts. Isn't that a good piece of news for them? Got to do a news conference, but no forecasts.
No forecasts, so they don't have to say anything. I do wonder if they're going to give a hint about two-sided risk, of the idea that maybe they could raise rates at some point again. And if that's the case, that would be a pretty big shock to the market.
We'll have that conversation in just a moment. In the third hour of Bloomberg Surveillance, we'll catch up with Tom Kennedy of JP Morgan Private Bank, Stacey Raskin of Bernstein, Lauren Goodwin of New York Life, and Matt Dizok of Merrill and Bank of America Private Bank. All of that and more coming up next.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent the Bitcoin on beer and groceries and gas and video games.
And
I wish I had kept it. I wish I would buy a Harley today if I had.
Yeah, but you probably wouldn't be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that is.
I'd be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
Maybe the Mag 7 aren't as dominant as they have been. I don't know that that's a bad thing.
The game's going to continue to change as far as kind of the AI ecosystem is concerned.
The Mag 7 stocks are 34% of the S&P. We're all tied to these 7 stocks, and in particular, we're all tied to NVIDIA.
I do think it's a threat to the expectations that we had coming into this year.
It certainly looks like a fairly tough year for investors. US exceptionalism can persist, probably not to such a significant degree.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The open bound 90 minutes away. 2 places to look. Let's start with the equity market. Equity futures bouncing back by just 0.2%, up 0.25% on the Nasdaq 100. A mega sell-off on one single name yesterday, NVIDIA. NVIDIA losing almost $600 billion of market cap in a single session. This morning, bouncing back, Lisa, by just 5%.
I want to sit on a point that you made earlier this morning in a question you were asking that I thought was really important, which is a lot of the commonplace narratives going into 2025 were upended yesterday. There was this question around AI dominance and how much it would really be about financing the chip sector. There was a question about how we get runaway growth and inflation that would cause rates to go higher. And there was a question about the dollar and whether it would really strengthen. That, I think, is the biggest takeaway, how fragile some of the consensus positions are at a time where some people are worried about just how concentrated gains have been.
And also at a time when there's still so much political uncertainty. We've been talking about tariffs all morning, but that's because the situation feels very fluid. I mean, the president said it himself. He has the number in his mind, but he's not ready to set it yet. So unless you can read minds, it's very difficult to have a base case or even a timeline of when potentially we could see these tariffs levied at Canada, Mexico, or China.
So universal tariffs were at like 2.5% and above. That's all we kind of know right now. It's not 2.5, it's above. Then individual tariffs is 25, this is the threat, on Mexico and Canada. 10% on China maybe, and Europe. What we've heard from Europe at the moment is that Europe's going to get it too because of the trade surplus. So what that means in practice, I still don't know.
Okay, so Mexico is importing things from China, and that's bad, and it's also the immigration issues. Canada is Canada, and you can beat up on them because they're Canada, evidently, and they're close by. Colombia had to do the immigration. What are these being used for, and how these tariffs are being implemented are not consistent. So that's the reason why it is hard to come to any real conclusions across the board.
No, but we did get more color on actually what the president is thinking yesterday when he was talking to Republican congressmen and women. He was talking about the fact that also he wants to go after aluminum. He wants to go after copper because of the U.S. industrial base. He wants to make sure that we have all of this production in the United States. And then he also talked about the fact that you need tariffs to pay for tax cuts.
One man changed the conversation, Donald Trump. When he came into Washington, D.C., this was not a bipartisan issue. Donald Trump completely changed the conversation on this issue. And I think anyone who's saying, you know, he's not going to go through with some of this stuff, I pour some freezing cold water over those arguments big time. There's many reasons to go at China, a lack of reciprocity at Europe. It's been a protectionist trade bloc for a long, long time. Ask many countries and companies who have tried to deal with Europe and they'll give you a decent opinion on that. And as for Mexico, the southern border is a massive issue and wasn't the election, and he wants to do something about it.
I think that those are all completely correct takes, especially given the fact that the tariffs that were put on under the Trump era stayed on under the Biden administration. And frankly, there is a lot of bipartisan support for particularly levies on China. That is the reason why people are wondering why Denmark and Panama are in the crosshairs in Canada rather than, focusing on some of the other players.
This agreement has geostrategic importance, and I think we all understand that. So I agree it gets confusing when you try and throw everything against it.
I mean, it's like Gulf of America, Panama Canal, what's going on, Denmark, give us Greenland.
Panama Canal on the margins is about China. It's the fact that China has these ports there. They're controlling the canal. And Greenland is also not just about Canada, but also about Russia and how important the Arctic is to both these countries.
We'll see what the weekend brings. Equities right now on the S&P positive by close to 0.2%. Coming up through the next hour, we'll catch up with Tom Kennedy of JP Morgan as DeepSeek rattles global markets. Stacey Raskin of Bernstein on why the ensuing panic is likely overblown, and Lauren Goodwin of New York Life on why Goldilocks economy is the Fed's to lose. We begin this hour with stocks looking to recover. Tech bulls getting a brutal wake-up call as China's AI startup DeepSeek calls into question US tech leadership. Tom Kennedy of JP Morgan saying we are moving fast through the AI tech build-out, and volatility in the sector suggests adoption is set to accelerate. The winners, Main Street, big tech and China. The losers, AI infrastructure spending and US exceptionalism. Tom joins us now for more. Tom, good morning.
Good morning.
Certainly saw that play out yesterday. Is that a short to medium term call for you, or something you see playing out over the long term?
I think the big takeaway is that this movement through the AI adoption phase is happening a lot faster than we all thought. If you break it down, AI technology build out in 3 simple phases. One is proof of concept. OpenAI did that for us a couple years ago. Then we thought we were in this multi-year build out of the infrastructure to support adoption, and DeepSeek accelerates us through that. So now I think the incremental next 3-year look is you got to start to rotate more towards the application phase. And what that exactly looks like still remains to be seen, and we're experimenting and figuring out. VC community is very focused on robotics, but there's more to do. And from an investing perspective, that middle phase, shorter than we thought.
So from enablers to adopters, is there a preferential sector, a preference right now on a sector basis for you?
I think in the long way, you're going to get the big broadening out as the first takeaway. That U.S. exceptionalism, you guys talked about it, these really consensus views walking into the year. We were U.S. exceptionalists too, but this is a dent there for sure. So the broadening out to Main Street is a winner, also potential for Europe. If you're going to get mass AI adoption, you'll get the productivity quickly. But our preferred sectors are still tech, industrials, utilities. This is a real question now. The intensity or the bottleneck in the infrastructure, maybe it eases a little bit, but if we're going to get adoption in AI a lot quicker, volume will really pick up quickly, and you're going to need the infrastructure there too. So we still like those sectors, again, at a price, and you just got a better price at them.
So basically, you're not buying NVIDIA in the dip?
I think what you need, the infrastructure play is more than just chips, is the point. And it starts to circle around other topics you're talking about here too. Infrastructure build out for immigration, infrastructure build out for separation from China, and the picture is more ways to win in an infrastructure build. Still think the chip play is there, just don't think you're there at this moment at this price.
So there was something else you said about U.S. exceptionalism.
Yeah.
Does this mean that you think the dollar is now going to weaken steadily from here?
No, we don't have a steadily weakening dollar, but the notion that AI innovation and AI exceptionalism in America is going to push the dollar higher, it's unlikely to be there. I think often we don't take the time to what causes AI, what causes U.S. exceptionalism. It is tech innovation. We have the highest earning companies in America. It's immigration. People want to move to America. Trump is trying to do deportation, but over 200 years we've had net immigration to America. Common law system and a world where people are going to inflow capital here. There's many ways the U.S. exceptionalism still works. And in America, the productivity output that we're getting from growth is just unmatched elsewhere.
I just want to understand what you believe about DeepSeek.
Yeah.
And then build on that. Do you believe that it was built for $5-6 million? Do you believe that they did this? And I'll quote NVIDIA directly in their statement that came out yesterday when NVIDIA turned around and said they leverage widely available models and compute that is fully export control compliant. Do you believe that it's fully export control compliant? Because I think what we believe really, I think, shapes your investment thesis beyond that. Because if you believe all that, it upends a lot of things. Do you believe all that?
I don't know what to believe on all of that. How exactly they did things, from what we're told, this was the final leg of the training was done with low cost, older chips, and leveraging prior best-in-class models. Now, the legality of that is not necessarily my concern. But what it does do is open up the opportunity now to scale AI much quicker than we thought. If I don't need the compute power, which was perceived to be a bottleneck, and I don't need the infrastructure, again, another perceived bottleneck, I can accelerate adoption. And that means AI brings to the masses and productivity can pick up. It benefits the players in the space that don't have the capacity to spend big on this.
So productivity picks up. What does that mean for your call on the economy more broadly?
It probably means there's upside skew to our view on growth, and there's downside skew to our view on inflation. All else equal. As we figure this out, though, that's a higher for longer world.
Just quickly then, yeah. That's what I'm thinking about. Do you think there's questions to be asked of Chairman Powell tomorrow?
Yeah, I mean, my two most important questions I'd want to sit there if I'm sitting there in the audience. Are we still meaningfully restrictive? What does that word meaningfully really mean? And can you cut rates in of itself if just inflation cools? Is that sufficient to cause the cuts? Those are the two questions I would ask. And maybe those are the only two questions we're actually going to get fun intelligence tomorrow.
There is this feeling that there could be an opportunity for Jerome Powell to open the chance for two-way risk, to either hike or cut at some point this year. Do you think that would be appropriate, given some of the technological transformation and some of the uncertainties?
No, I think it's quite unlikely he'll do that, is open the door to a hike.
But do you think he should?
No, I don't think he should. Mostly because the labor market is what matters the most in America. And momentum in the labor market is still cooling. Some could argue stabilizing, but it's very hard to argue that the labor market is retightening here, in my opinion. So the most indicators to look at, quits, hires, initial claims as a way for stabilizing and reacceleration. So until you see a tightening there, I don't see any reason to think that hikes are necessary.
Trump is currently, though, carrying out deportations, which could mean a tighter labor market, no?
Biggest risk to this call is that he will change the supply and demand dynamic in the labor market by reducing supply. In his first term, Trump ran on deportation in his first term. His deportation rate was about half that of Obama's. So using history as a guide, I do think there's a big risk here, just low probability that mass deportation changes this.
But if we were to see that, then would you consider potentially a hike has to be on the table?
Without question. I think it's hard to argue that the soft landing would have been possible without the immigration surge. So the opposite of that, Amory, would be a risk for sure.
Just going back to the very beginning, you said that yesterday you really did question some of the holdings that you have. Have you taken action on that? What are you waiting for to really decide whether you have to shift some of your views for 2025?
Yeah, I think the things that we talked about, winners and losers here, are Main Street's a winner. These big tech names, though, are not an obvious loser to me. The big tech hyperscalers, your top 5 names, they have access to the software and the interaction with their clients, so volume can actually sustain them. But from a loser perspective, we have to question the infrastructure build-out. And it's about chips, it's about power consumption, it's about power generation, it's about water, cooling, land. Like, that's what we're questioning right now.
These moves yesterday, we mentioned a few of them: pipeline operators, gas producers, utility providers. Lisa, they were huge moves in yesterday's session.
And it came off the heels of two things. First, that everyone was believing this story, that there was going to be an infinitive sort of infinite amount of demand for energy and infrastructure as a result of artificial intelligence. But it also speaks to just how high valuations had gotten at a time where there were so many different stories that were converging.
There was a forecast for warmer weather in the mix as well. So I know it's hard to divide the two issues, but to see natural gas down as much as it was yesterday.
You think it's because we're not, 2 degrees Fahrenheit here in New York City?
Yeah, there was a weather element to the move we saw yesterday, particularly at the front month, in futures.
Sure.
But further out, the move you could see, that's all about energy use. And I think that just speaks to a part of this being good news, if it's real. it can be very good news.
It could be very good news because you couldn't have the adoption people were talking about with the energy that we had. So this actually is a positive and potentially disinflationary, which is the reason why we hope that Fed Chair Jay Powell addresses the NVIDIA question tomorrow at his Fed conference.
Mike McKee is going to ask questions in the news conference. We'll make it happen. Tom, it's good to see you. Appreciate it. Thank you, sir. Tom Kennedy there of JP Morgan Private Bank. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Scott Bessent has been confirmed as the next U.S. Treasury Secretary, winning a Senate vote 68 to 29. That included support from 15 Democrats. The former hedge fund manager's policy objectives include 3% GDP growth and a 3 million barrel per day increase in U.S. oil production. President Trump weighing in on the future of TikTok, saying Microsoft is interested in buying it. Microsoft declined to comment on any involvement in a possible deal. AI startup Perplexity has submitted a bid to merge with TikTok US, while billionaire Frank McCourt, former owner of the LA Dodgers, made a formal offer to buy the company earlier this month. Shares of JetBlue are tumbling 8.4% in the pre-market. It posted a fourth quarter loss per share of 21 cents. That is better than a loss of 31 cents that was estimated, but it was its cost outlook that was higher than expected. They're expecting it to rise 7% in 2025. The results are a setback for JetBlue, which had been focusing on reducing costs and improving flight operations. And that's your brief, John.
Danny, appreciate it. Thank you. More from Danny in about 30 minutes' time. Up next on the program, the Morning Calls Plus, Stacey Raskin of Bernstein saying market hysteria over DeepSeek is likely overblown. That conversation up next.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Lots to get through as we approach the opening bell. 1 hour and 13 minutes away. Equity futures positive by just 0.2%. Let's get you some morning calls. First up, Morgan Stanley trimming its price target on Broadcom to 246, highlighting anxiety sparked by DeepSeek and a lack of short-term momentum. That stock bounces back by close to 4%. Your second call from Melius downgrading AMD to hold, citing increasing competition from NVIDIA. That stock is just about unchanged. And finally, JP Morgan reiterating its overweight on that stock, saying AI efficiency gains shown by DeepSeek should drive further innovation. That stock is bouncing back by just 3% this morning. Let's stick with NVIDIA, the chip maker, erasing some of yesterday's losses after Chinese AI startup DeepSeek triggered a $589 billion round. Stacey Raskin of Bernstein, weighing in on DeepSeek and writing the following. The models look fantastic, but we don't think they are miracles. And the resulting Twitterverse panic over the weekend seems overblown. Stacey joins us now for more. Stacey, welcome to the program. You addressed my first question in the line before the line I just read, but I want to repeat it and ask it to you, just so our audience can really gauge where you're coming from. Do you believe that this cost around $5 million to build?
Of course it did, and frankly, like it says so right in the papers. So I do think part of the problem with the stock and frankly with the whole space yesterday is that the headlines that kind of emerged from all of from the circus over the weekend was basically, oh my God, they built OpenAI for $5 million. It's clearly not true. They actually had a cluster. I got to say that there's actually two models. There's a base model, it's called V3, and then there's a reasoning model called R1, which is the one that everybody's getting angsty over. V3 was chained on a cluster of fairly high-end NVIDIA GPUs. And they clearly had, tens or even potentially hundreds of millions of dollars of work that went into it to work on research and algorithms and everything. And they say right in the note, like, they don't include that. So, and this was just for the V3 model. They took the V3 model and did reinforcement learning and other things on it to develop R1, the reasoning model. They did not actually disclose what they did to train that reasoning model. So actually, I don't know how efficient it was to do that. I do know that the V3 model was very efficient, and there were some reasons for that, the structure of the model and other things. And as I said in the paragraph you just read, the models are all, they're actually really, really good. I don't want to discount that. They're fantastic models. The types of things that they did, though, are not miracles. They're not unknown to the rest of the AI community. And I mean, none of this was secret. I think their implementation was very clever because they're under some constraints due to the export controls. They've got to work very well and very efficiently with what they have. And I think they've got a bunch of really cracked engineers over there. They did a really good job. But I think in general, the whole thing, like the 5 million number and everything else, just caused a complete and total panic, which I do think was overblown. I really do.
And Stacey, we saw that across the board. It goes beyond the chip makers. We saw that from natural gas prices, energy providers. Sure. We saw it from pipeline companies as well. Stacey, there was this line from NVIDIA yesterday that we keep bringing up on this program. We'd love your input on it. They say that it is fully export control compliant. And Stacey, I just wonder how we even know that. How would we know that?
Well, I don't know what they're running on now. The stuff that they trained V3 on is no longer export compliant. They supposedly trained it on a cluster of 2048 H800 chips. H800 it's a derivative of NVIDIA's H100, which is a very, very good chip. It's the exact same compute, slightly lower chip-to-chip bandwidth. Those parts are actually no longer export control illegal. The controls in October of 23 cut that off. I don't know what the new stuff is training. My interpretation of that statement was whatever they're doing, it's running on our stuff, or it can run on our stuff, right? And this gets to a broader question, by the way, because like the biggest question that people have, there's the near-term questions: is this going to cause a pause in shipments or orders or whatever? The longer-term question is: do we structurally need fewer GPUs and less compute in order to do this? And I am not a believer of that. Again, you compute growth, like installed compute in the world's data centers, even before AI was growing in leaps and bounds every year forever. I don't think we can ever have enough compute. People have been spouting it like for the last like all over the place last day or two, but everybody's been talking about Jevons paradox, which is the idea that as costs come down, demand goes up, and demand goes up more than offsets the cost reductions. And remember, I'm a semiconductor guy, right? In semiconductors, costs got cut in half every 2 years for 50 years. It wasn't bad for semiconductors. It was really good. So I am maybe a little biased, but I am not of the opinion that we can ever really have too much compute. And I am certainly not of the opinion that the compute that we do have was anywhere close to the limit of what we're going to need if AI is going to take on the potential that I think the industry thinks it can. And because of that, I think we actually need efficiency improvements. I think even on the GPU side, your performance has improved by more than 1,000x over the last 10 years, and that keeps going. NVIDIA said they want to improve by another 1,000,000x over the next 10 years. Well, these are the types of efficiency improvements that we need if we're going to get to where I think the industry wants to go.
That said, Stacey, it's going to be a bumpy path. And this is sort of the concern that a lot of people have, that essentially the big tech players that have been spending a significant amount, billions of dollars on GPUs from NVIDIA, are going to feel pressured to ratchet that back a bit until they really understand what kind of models they need to really follow. There's a feeling that that is the near term that we're going to be looking at. Why do you disagree with that?
Well, look, so the worries about like air pockets and digestions, these are not new worries, right? Those were concerns, you know, the last week and the month before and the year before. So this is not an unknown thing. I actually do think in the near term, you know, the biggest question for NVIDIA like this calendar year is their Blackwell ramp. And I would be shocked if anybody's canceling like Blackwell. What we saw even last week, all this was purchase intentions in general going up, not down. Meta raised their CapEx guide by a massive amount, right? We got the whole, you know, Stargate announcement. Even China announced like a 1 billion yuan, like 140 billion US dollar investment program in AI for the next 5 years. So we're seeing purchase intentions go up. And I'd be shocked if anybody's canceling like their Blackwell orders. I do think people are going to be wondering what it means for next year as Rubin like starts to roll out, and are people going to rethink like their trajectory for Rubin. And again, that was a worry and a concern before. It's not new. We'll probably learn more about that in March. NVIDIA has their GTC event where we'll get more color on Rubin. We'll see partner announcements and all kinds of that. So we'll be able to gauge a little bit more in March. This probably is part of the reason with one of the issues with the stocks in the near term right now is there's going to be more uncertainty, clearly. And the thing is, even if you think that this is not an issue, like it's impossible to prove a negative, right? And so people are going to be free to worry. Like it may sit on the space for a while. Like absolutely, I'm not saying it won't. We'll have to see how things evolve as we go through the year. But I'm still pretty positive long term on the prospects. Is there near to medium term, you know, potential, you know, digestion risk or anything? There always is, but that was true before. I don't think that the idea of that is now like new because all of a sudden we've heard of DeepSeek.
Stacey, just quickly here, I am wondering whether this does indicate that China is much further along in some of its technological development and that potentially it could be a real competitor even in the chip space, which we know they're trying to make headway in.
Yeah. Well, see, this is one of the consequences of the export controls. And sometimes people do their best work when they're under constraints, right? And again, it's not like the Chinese are stupid, right? They have fantastic engineers and fantastic talent over there too. And, you know, and you can look at some of the things that they did in this case. Some of the things they did because they were constrained on the hardware that they could run on. They had to make choices that like ordinarily you maybe wouldn't want to do, but if you have no choice, you'll do them. We've seen this in other areas too, like just on process technology. They can't buy tools that can do leading edge. Huawei, however, is making chips on what's called 7 nanometer, which would be a process technology that would be banned. They're making them at SMIC, but they're using techniques to do that which are not going to be cost effective, and like they're things you would not want to do, but if you have no choice, you'll do them. We see the same thing on the semi-cap side. There are local semi-cap players that are gaining share in China because they have no choice, right? They have to buy them, so they will.
Stacey, I could talk to you all day. This was fantastic. Let's do it again soon. Thank you, sir. Stacey Raskin there of Bernstein. Up next, we'll get you some economic data and some reaction from Lauren Goodwin.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
The open about 60 minutes away, some economic data, seconds away. Equity futures on the S&P just about positive by 1/3 of 1%. On the Nasdaq 100, up by 0.4. In the bond market, yields down across the curve in yesterday's session. Off the back of that risk aversion, the bond market received a bid. This morning, yields a little bit higher, up by 2 basis points on a 10-year 455 as we kick off the Fed's 2-day meeting down in Washington, D.C. With that economic data, let's say good morning to Mike McKee. Good morning, Mike.
Good morning, John. Well, you know, these are the numbers we want to see, but maybe not the month we want to see them. We want to see what impact the president's policies are having on business investment. But this is December data, when Joe Biden was still president. Capital goods orders, non-defense ex-air, which is the number that really is a proxy for business spending, up 0.5% during the month after a 0.4 rise in November that had originally been 0.7. Durable goods headlines down 2.2, but that is usually heavily influenced by the Boeing and auto company results that we see. So we'll look at ex-autos, ex-transportation, up 0.3 after a 0.2 decline the month before, and capital goods shipments up 0.6, which would be good news for the GDP numbers in the fourth quarter. But right now, it's the capital goods orders, non-defense ex-aircraft that people care about, and that's up a strong 0.5% during the month. That's more than anticipated. We'll see if that continues into the Trump administration.
Mike, given the constant threat of tariffs, and I'm not sure how you separate the two administrations, given we were aware of the constant threat of tariffs back in December as well, would you expect some front-loading of some orders?
Yeah, you would, and you would think that perhaps people were trying to get some front-loading in there. Now, we just got a revision to the capital goods orders. They were up 0.9 in November and 0.5 in December, so it does look like there is some front-loading there. A study out from Chicago Booth School this morning suggests that consumers are doing the same thing. They were stocking up ahead of potential tariffs. So we may see a stronger than expected fourth quarter GDP number because people were worried about all of this.
Mike McKee, appreciate it, sir. We'll touch base with you on the Federal Reserve in a few moments' time. It's an intriguing way of doing stimulus, isn't it? The constant threat of tariffs and getting people to spend and front load some of these orders?
Yeah, although it does lose its potency after a while if you keep using it. But that does seem to be what a lot of people were talking about, that essentially retailers in particular were trying to get ahead of any tariffs by stockpiling. Let's just hope they didn't do the same things that they did during the pandemic when they got lots of Lululemon pants and sweatpants and they didn't get other ones.
Sounds personal. I'm not sure who you're talking about.
It's true. It actually was. Remember with the retailers? The retailers all had trouble because of the sweatpants.
So like finance pros start buying Lulu as well.
Yeah, well,
they start buying Lulu pants.
They're good pants.
I thought it was Viore is the new thing.
To go with the vest.
Yeah.
You know, the Patagonia thing. Is that still a thing?
Did you see any men wearing leggings?
Too cold for the Midtown uniform. No, they don't wear leggings, Bramo. That's not what I'm suggesting.
It's the vest.
They wear the work vest.
It's the Midtown uniform,
okay.
yeah.
I know, but that changed.
Okay, anyway, all right. Let's turn back to the Federal Reserve. They are awake. The two-day meeting has started at 8:30 Eastern Time. Just getting confirmation of that across the Bloomberg terminal. Joining us now to discuss is Lauren Goodwin of New York Life. Lauren, it's good to see you.
Thanks for having me. I like Vuori pants for what it's worth.
I'm on board with the Vuori movie.
Totally agree. I really enjoy
soft,
them.
So comfy.
So soft, so comfy, great colours too. We can talk about this another time. I don't know if Chairman Powell's into Vuori as well. What are you expecting from the Fed chair tomorrow?
Absolutely nothing. In fact, I think it's Chair Powell's express goal heading into this meeting to say as little as possible. The Fed is sitting on a perfect Goldilocks moment, and it's probably not going to last. But if you look at all across the markets, market financial conditions are good. The 2-year yield's been sitting right on top of the Fed funds rate. Labor, inflation in pretty good balance. There's nothing they should do other than wait for more information, which includes information about how policy is going to impact their 2 mandates.
Which speaks to what you said a little bit earlier, which is probably not going to last. What do you think disrupts it?
Frankly, I don't know. There's just so many things that could disrupt it. If we look at the underlying sort of impulse of the economy, we've seen that the disinflationary process is pretty much intact. In fact, I really hate when this happens, but I agree with Max Kettner, who you had on the program earlier, and with disinflation being, I think, more important for the markets than has maybe been getting attention. You also have the labor market looking pretty strong. There's a lot of runway for the Fed to let growth move back closer to trend without doing a whole lot. But the types of disruptions that we could have are the policy pull forward. We're seeing not only potentially orders being pulled forward, but inflation expectations moving higher. These are the types of disruptions that are just sentiment right now, but as they transition into potentially reality over the next 3-6 months, that's very much in the Fed's timeline.
So do you think that the most underpriced reality is actually that the Fed would be cutting more, not less, even amid a pretty strong growth backdrop?
I don't know that that's the case. Again, the underlying sort of impulse of the economy has been for this gradual disinflation, but inflation is still sticky, and the fact that market rates are still sticky is telling me that investors are very concerned about what that future glide path looks like. And so I take the Fed and the market at its word, where a couple 25 basis point cuts this year is probably a reasonable base case when you're looking at a statement of economic projections that says, look, growth is going to come down a little bit closer to trend, but inflation actually maybe not so much over the course of this year.
So tomorrow when we talk about the Fed meeting, we're going to be talking about inflation, we're going to be talking about rate cuts, but really what everyone's going to want to know is how politically influenced is the Federal Reserve, what's Donald Trump going to be saying, how much is there going to be some sort of shadow Fed later this year that could undermine the Fed chair. How much does that factor into your base case for markets at a time where we know that's all going to happen to some degree or another?
So it doesn't factor into our asset allocation at all, because it's not something that at the end of the day I'm worried about. But I do think that it's going to be very much a part of the conversation, and I think it's an important conversation. The line that the Fed is going to have to walk here, because there is going to be, as we've already seen, this attempt at interference, the line that they're going to have to walk is that we have seen this movie before. We have not only the period in the 70s and 80s, but also the post-war period where we've had double peaks in inflation, and interference in central bank activity was a big part of that double peak in inflation. They've seen that movie before, and they don't want to play into that movie again. That's a message that we've seen Chair Powell iterate in really strong and frankly fun and funny language at press conferences before, but they're going to have to keep doing it. I think it's going to continue to be a part of the conversation.
But didn't he open the door to that himself when in November he said, we don't assume, we don't guess, we don't speculate, and then they assumed, they guessed, they speculated?
It's a really good point, and I think at the end of the day, this just comes down to these are economists, or in Chair Powell's place, not a PhD economist, sitting around looking at data and conditions, just the same as all of us, where you don't want to make bold assumptions about policy or about the trajectory of the economy when you don't have good information, but you have to because you're trying to sort of shield the business cycle from that potential interference.
But not everyone on the committee assumed. So then you're left a little bit of uncertainty of trying to understand who is approaching what the economy is doing now, what the economy might do in the future. Isn't that in itself the Fed being uncertain?
It is. And so then from an asset allocation perspective, I think some of the lessons or sort of through lines that we can take from it is that we are dealing with a really quite constructive economic backdrop with a lot of uncertainty. And I think that one of the reasons we've seen such resilience in the markets, including with market-related uncertainty like in the last 24 hours, is because of that economic resilience. And when you're thinking about how then to allocate a portfolio, we can feel pretty confident in areas of the market that haven't been discussed very much over the last couple of days, like credit. If you have a Federal Reserve who is on balance in the process of cutting over the course of this year, even if it's not very much, an economy that's strong, and an impulse actually that's looking quite positive at the moment, that's an environment where we think staying invested is more valuable than not.
It was easy to say that we don't assume, guess and speculate back in November when you didn't have to put out forecasts. Then in December you had to put out forecasts. The very fact they don't have to this time around, it makes it a little bit more easier, doesn't it? Tomorrow afternoon.
They don't have to quantify it, and they don't have to give transparency about who is assuming and really planning to incorporate some of what we've heard so far. That said, there is this feeling that's looming over the Fed, which is that Donald Trump is going to call them up and he's going to tweet at them and he's going to exit them and he's going to basically say, you know, guys, rates have to go down, and then they have to really dovetail this very sensitive kind of historical lesson, maybe at a time of potential transition.
Some commentary from the strategist Donald Trump around 2:35 Eastern would be perfect.
You think so?
In the news conference.
Oh, so excuse me.
Just
Mr.
perfect time. Exactly.
Yes.
Yeah,
exactly.
I think he will be truthing live.
Lauren, it's good to see you. Appreciate it.
Me.
Lauren Goodwin there of New York Live. Mike McKee will be in that room in the news conference. Mike, what's on the agenda for Chairman Powell tomorrow?
Yeah. Well, I think Lauren put her finger on it. He's going to try to say as little as possible, make no news at all. You know there are going to be a question or two on Donald Trump coming. The issue for reporters is, how do you ask something when you already know that he's not going to answer? We sort of have to get him on the record saying we don't know what's going to happen, so we're not going to make any assumptions. But right now, we also know that's what he's going to say. So I'm not sure we get a whole lot of clarity there. And as far as what they do going forward, he'll dodge all of that as well, saying we're going to wait and see what happens. So unfortunately for the markets, they're probably not going to get a lot of direction out of this.
Mike McKee, we can only hope. Good luck tomorrow. Michael McKee heading down to Washington for the Federal Reserve's meeting. Look out for that news conference and, of course, special coverage from us that starts at about 1:30 Eastern Time. The decision 30 minutes after that, and the news conference begins 30 minutes later.
I feel like every single person who's coming on is basically saying, don't have to watch it. You can just turn it off. And so I really am curious, if the bar is so low for the Fed chair to basically say nothing, will he embrace that bar, or will he mess up? Basically, will he do nothing, or will he say something that he thinks or feels, and that's going to be a negative?
Matt Diesel can answer that, of Maryland Bank of America Private Bank. Matt, it's good to see you.
Good to see you, John.
How low is the bar for Chairman Powell?
That was a great point Lisa was making. The bar is pretty low, and again, we're not expecting much from the meeting. We're expecting steady as she goes, watch the data, but that does leave the possibility that people do get surprised. Chair Powell had said rates were meaningfully restrictive at the last meeting on December 18th. At that point, the 10-year is in that 4.25 to 4.30 range. We just recently got 55 basis points higher than that. So we thought that was meaningfully restrictive. How does it feel about the 10-year that much higher? So it's always possible he says something that actually makes the market take a dovish implication from that.
Do you believe we are meaningfully restrictive?
I don't think we're meaningfully restrictive. I think the idea of a neutral Fed funds rate divorced from the economic environments doesn't make a lot of sense. Obviously, we have deficits right now about 7% of GDP. The usual deficit is 2 to 3% of GDP. You can't have a deficit 2 to 3 times the normal level and say it's the same restrictive Fed funds rate. So 4% with a 7% deficit is probably a lot closer to neutral. If you had a 2 to 3% deficit, sure, then maybe 2 to 3% Fed funds rate, but it has to be calibrated relative to the economic environment. We think they're restrictive, but meaningfully restrictive, we'd probably fade that a little bit.
At the same time, haven't they been kind of given a pass by the fact that we just saw this rally and concerns about NVIDIA? So, oh yeah, we don't have to really be a problem. Like, we don't have to take a look at the long end that much. And, you know, there's something to see here. Can't they kind of punt on that?
I think if the market volatility continues like we saw the last day, possibly, but I don't think they're going to look too much into one day, too much into one company. And again, I do think the 10-year is going to be very important for them because the Fed funds rate doesn't affect the economy as much as longer rates. And obviously how they talk about the Fed funds rate, what they expect for the Fed funds rate is what really drives long rates higher. So we believe that they're probably on hold for the rest of this year, but the risk of that would be another cut or two, which is what the market believes.
As a market participant, as someone who actually has to invest, how much do you care about the tit for tat that is inevitable between Donald Trump and Fed Chair Jay Powell?
Well, I think the idea of central bank independence is important. That's been in place for a while. But we have to take a step back. There's nothing new under the sun. And politicians and central banks having different points of view always makes sense. You go back in financial reserve history, obviously there were times that there was a lot of discussions between the central bank and between the administration. LBJ taking a Fed chair down to Texas, had got very vocal with them, backed them up against the wall, kind of poked them in the chest. So there's definitely times where there is some disagreement, I will say, between Fed chairs and the administration. We believe, as Chair Powell has said, the Fed is independent. They will do what they think makes sense for the economy, and we think that'll be the right way to move forward.
How difficult might it be, though, when you start really hearing more news reports about Trump coalescing his ideas and thinking behind the next Fed chair? We already know some lists, potentially, that he might appoint for 2026, but by mid-year, you might hear more about that one individual, and that person speaks, they're going to probably carry more weight when it comes to the market.
Well, I think the structure of the Fed is set up, so they have different governors, different terms, people rolling over at different points, and so it's not that unusual to have a Fed chair change during administration, so we're not overly concerned about that. And again, while Chair Powell is quite important, he's one member of a broad committee, and just changing one chair, we don't think will have a major impact with everyone at the Fed and the entire committee, which all have a very important voice and all have votes.
When it comes to what we saw over the past 24 hours, with basically tech stocks just getting absolutely hammered, $600 billion wiped out for NVIDIA, you still say the U.S. best game in town in terms of growth. Do you still think that U.S. exceptional reigns?
Yes, we do believe, especially in terms of asset allocation and economic growth, the U.S. is the place to be right now. Obviously, we've seen a number of high flyers, particularly in the tech sector over the last couple of years. If you strip out those valuations from the market, the rest of the best, as we call them, valuations are not extended there. So we're not overly concerned about some of the high flyers not flying so high. We see the market broadening out. We saw, it's too early to call it a trend, but we've seen the equal weight of the S&P start to outperform, and that's kind of our belief. We've tilted more diversified, making sure we have other sectors, not getting too overweight tech, so we don't mind a little volatility there. That's to be expected. And again, it's going to be a chop and grind this year. We don't expect valuations to extend in the equity market. We believe the equity market will follow earnings. Our earnings trajectory is positive. Again, the deficit picture is a big part of that story, and so we're not overly concerned about volatility in some sectors. The rest of the market is appropriately valued, we think, to deliver reasonable equity returns this year.
So 60-40 is sort of back with pretty middling returns.
We've never thought 60-40 was gone. We like 60-40. We do feel better about 60-40 now because it's not that difficult. Don't tell anyone else, but being a fixed income strategist is not that difficult, right? Right now, you look at the ag. You can get 5% on high quality fixed income. That means year in and year out, you're going to get 5%. That's how fixed income really diversifies. A steady, reliable yield year in and year out. But let's look at the risk reward. Let's say we're wrong. The Fed's not only done cutting, let's say they hike, not one, not two, not three, not four. Let's say they hike 5 times, right? Let's say the curve moves up in parallel fashion. We can all agree that's a pretty conservative assumption. In that instance, on the ag, you'll basically get, over the next year or so, only a negative 2.5% total return. On the flip side, if rates move 125 basis points lower, you're going to earn approximately 13%. The risk reward, when yields are higher, are so much more favorable for a diversified investor. That was not the case when the 10-year was 1%. The symmetry is pretty much 1 for 1. So we feel this is a good place to extend out your investment cash, to get longer fixed income in terms of duration. We're more favorable in duration now. We're still neutral. We're slightly long. But at these levels, if you got slightly longer here and then added again above 5%, we feel tactically that will work, but you don't have to. You can just be 60-40, you can be strategic. Fixed income will do a very good job of giving you additional returns here.
So what is the one thing that could potentially upend your view?
The major change would be a sustained increase in inflation. Right now, the Fed wants a better labor market. They like the stronger job market. That's not a problem for them. Our belief, and we believe the Fed's consensus belief, is that tariffs are not overall inflationary. They'll lead to a one-time bump upwards in prices, but people change their behavior. I mean, tariff's just a tax. What do you get when you tax something? You get less of it. So consumers will probably adjust. As long as that's the case, we feel we're in the right range. It would take a really sustained increase in inflation to really change the Fed trajectory. And without the Fed purchasing bonds from the government and financing those deficits, we think any major inflationary impulse is quite unlikely.
Hey, Matt, it's good to see you and catch up with you as always. Matt Desock there of Merrill and Bank of America Private Bank. On fixed income there, as BMO's Ian Lincoln said yesterday, still need to resolve core uncertainties around the policy of the new administration.
Yeah, and the ramifications of them. And with the tariff policy, the idea of Scott Bessent talking about 2.5%, just low grade across the board. Some people think that's actually more inflationary because it wouldn't restrict some of the consumption. It wouldn't increase costs enough to restrict consumption, but it would bump prices up, especially at a time where consumers have gotten kind of used to fungible prices at any given time.
You've got to understand what's happening elsewhere, the tit for tat, what happens with the FX channel. Nothing is obvious about any of this. 2.5 might be seen as a starting point, might be seen as the end point. Again, nothing is obvious about that either.
How many times do I have to say I have no clue this morning?
I don't think
have
anyone
no clue.
does.
Yeah, I know.
I don't think anyone
I think you're right. I think you're right.
Let's give you an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to someone who knows everything. It's Danny Berger. Hey, Danny.
That might be just a slight exaggeration, John. All right, well, Israeli Prime Minister Benjamin Netanyahu is planning to visit Washington next week to meet with President Trump. People familiar say Netanyahu wants to speak to Trump about maintaining the ceasefire in Gaza. Israeli media is reporting that Trump's Middle East envoy, Steve Witkoff, is expected to travel to Israel this week to discuss longer-term solutions to regional conflicts. Billionaire investor Ray Dalio says today's AI frenzy looks like the dot-com surge of the new millennium. The Bridgewater Associates founder telling the FT pricing has got to levels which are high at the same time as there's an interest rate risk, and that combination could prick the bubble. The NASDAQ 100 doubled in 1999 before falling 80% in 2002. The same index has again doubled since the start of 2023. Google Map users in the U.S. will soon notice a change in their app. The Gulf of Mexico will be named to the Gulf of America. The change will take place once official government sources are updated to reflect that order by President Donald Trump last week. The Gulf of Mexico name will remain in use in the Mexican versions of Google Maps, and international users will see both names displayed side by side. And that's your brief, John.
Danny, thanks. Thanks for this morning. Appreciate it. Up next on the program, we'll set you up for the day ahead, bring you the calendar for the next couple of days. Big 24 hours coming up. Federal Reserve decision tomorrow afternoon. After that, numbers from Microsoft, Meta, and Tesla from New York City. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because you know, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equity futures barely positive, up 0.1% on the S&P 500. On the Nasdaq, after yesterday's losses, the biggest one-day loss of the year so far on the Nasdaq 100, we're positive by just 0.2%, 36 minutes away from the opening bell. With your morning movers, it's Manus Cranny. Hey, Manus.
Jonathan, and the add back on that NVIDIA story of the $589 billion loss yesterday has dissipated through the morning. At one junction when we came in and started Bloomberg Brief, it was up 5%. We've given a little bit back. This is about reappraising the margin outlook for NVIDIA. By the way, Parimi Wealth was with us this morning. He sold $110 put options. He's bullish on the market. It's overdone. Quick look at the next stock. We've got General Motors. I mean, they've had their numbers, the operating profit. They've had a boost from the US and from China. They're making some pretty brave assumptions. They're saying the first form of guidance for 2025, we're going to earn between 13.7 and 15.7 for this year. But that's not assuming the tariffs are in there. I'll leave you with a look at JetBlue. We have a problem, a supply problem. Capacity constraints, fewer flights, and in the first quarter, a potential loss of between 0.5% to a 3.5% gain. That is way under the estimates. This is about capacity constraint in airlines writ large. Jonathan.
They're having a difficult time, that's for sure. JetBlue down by close to 9%. Manus, thank you. Big 24 hours coming. At 10 a.m. we get the Conference Board Consumer Confidence. Look out for that. Then tomorrow it all starts. 2 p.m. Fed rate decision, followed by the news conference at 2:30. Then earnings from Microsoft, Meta, Tesla. Thursday, an ECB rate decision plus results from Apple. And then on Friday, PCE. Is that enough for you? What are 48 hours coming up?
My question is, what's the most important thing? And I think everyone will agree right now, going into that without knowing any more information, it will be the tech earnings. Very much Apple, Meta, Microsoft. How much do we get a sense of how much they're adjusting their spend out on capital expenditures based on some of the advancements that we've seen?
One thing missing there as well, February 1.
Yeah.
February 1 and trade.
So I was going to say, on Saturday, there is a potential that we will get tariffs on Canada, Mexico, or China. We might not, but we could. That's basically as soon as it can come.
So the weekend is really a continuation of the trading week, because that could be a big weekend.
We work all the time now.
Are you trying to basically dampen
I don't want 24/7
Hold on a second. Am I just going to say?
No, I'm very against
Are you
that.
going to say, not let's get you to the weekend? Let's get you to February 1st. Well, we'll see what actually happens.
Very against 24/7
Okay, but maybe
markets,
that's where we're going to be.
Let's get you to the weekend tomorrow. Julian Emmanuel of Evercore, Lisa Shannon of Morgan Stanley, Nikolai Tangen of Deutsche Bank, look out for that, and a former Kansas City Fed president, Esther George. How many days until the weekend? It's only Tuesday.
It's only Tuesday.
Wow. Monday was brutal, wasn't it? Like a trading week in a single day.
Yes, that's
a
true.
year. From New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms. And he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Watch me fumble. Trying to bounce back after a brutal Monday. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Scarlett Fu. Matt Miller and Shanali Basic are off for the day. Bloomberg Open Interest starts right now.
Coming up, that $1 trillion wipeout driven by DeepSeek pauses. But, shocker, Black Swan author Nassim Taleb warns that yesterday's sell-off, just a taste of what's to come. And even still, that market faces a big earnings test this week, with investors hoping and praying that results from the Magnificent Seven will restore confidence in the tech sector. Plus, we have that dollar on the rise after President Trump wants to impose across-the-board tariffs that are, quote, much bigger than the 2.5% that were just floated by Treasury Secretary Scott Bessent. All of that and more coming up. But let's take a look at where these markets are trading. You did see a lift pre-market, and we're trying to hold on here, but those gains coming in a little bit on the S&P 500, up about 0.1%. The NASDAQ 100, we had been looking at pre-market gains of about 0.4%. That's faded a little bit, but still green on the screen. Going to be really fascinating to see how that one develops. And then you train your eyes on the bond market right now. We saw that big rally come in yesterday as investors sought a haven anywhere they could find it. Not so much today. Yields rising a little bit, 2 basis points on your 10-year yield, but we're still below 460.
Yeah, a little bit of a give back there, and that's kind of the theme with some individual stocks that we're watching too. NVIDIA shares inching higher after yesterday's historic sell-off prompted by concerns around AI competition from China. General Motors giving a better than expected profit outlook for the year. However, that guidance does not account for tariffs. Still, GM says it has a playbook if Trump adds tariffs to goods from Mexico and Canada. And shares of JetBlue plunging because its full year costs are higher than expected. The airline says it expects a drop in flights for this quarter. Katie, a stark contrast to what we heard from Delta and American.
Yeah, absolutely. Looking forward to digging into those results as well as Boeing a little bit later in the show. But let's talk a little bit about what's going on in these markets, because it was a brutal day across the board from the opening bell to when you were on air at the close, Scarlett. And it's interesting. Usually we meet in the middle of the day on Mondays for ETF IQ. So let's talk about the flows.
Okay.
They were staggering. You take a look at the Qs, of course, that big tech ETF taking in $4.3 billion, biggest one-day inflow since 2021. So clearly Amid everything we saw yesterday when it comes to that sell-off, some investors saw opportunity to buy this dip.
Yeah, definitely people were buying the dip, and definitely people were taking the opportunity to buy up on what they considered safe havens. Consumer staples, healthcare stocks all did very well. Even within the tech space, you saw Meta climb to a record high because it's seen as a beneficiary of cheaper AI, and also its Llama AI model is also open source in the same way that DeepSeek is.
Yeah, it was fascinating. You saw Meta and Apple end yesterday green. Both of those companies report this week, so it should be a lot of fun. But let's start this show with politics, because we heard a lot from President Donald Trump yesterday saying that he wants to impose broad tariffs that are, quote, much bigger than 2.5%. Of course, that was the number floated by just confirmed Treasury Secretary Scott Bessent. And this really is just the latest signal in how Trump is preparing to reshape the entire U.S. supply chain. So let's break it down now with Anne-Marie Hordern. She is Bloomberg's chief political correspondent, also the co-host of Surveillance, fresh from the other set. So he talked about a lot. Of course, we heard about DeepSeek, we heard about tariffs and a few other things in there as well. I think we got to TikTok.
Tax cuts, deregulation, TikTok, yeah.
So pick your poison. I mean, it feels like we should start with tariffs, as that's what seems to be making its way through the currency market right now.
Definitely, and also the fact that he did float that February 1st, which is Saturday, could be the first time we see these tariffs enacted on Canada, Mexico, and China. On China, it would be 10%. On Canada, Mexico, it would be 25%. But it's interesting because after he talked about tariffs as well in this speech in Florida, which he went and talked about aluminum and copper and semiconductors and pharmaceuticals, he was asked on Air Force One about this Financial Times article that allegedly the just confirmed Treasury Secretary Scott Bessent is floating this idea of a gradual, almost forward guidance, 2.5%. Now, this does ring true to Bessent's thinking, because in August, he told us on Surveillance that potentially that would be the way to look at tariffs. 2.5% for 2 years. Xi Jinping, tell us when it starts to bite before you get to that 60% on the campaign trail Trump was talking about. And when Trump was asked about this, he said, no, actually, it's going to be bigger. And then he said, I have the idea and the number in my head, but I'm not ready to set it. So it's kind of like, you know, he said at the debate, I have concepts of a plan, still is being worked out. And I think that's probably appropriate in the sense that this is only the second week of this administration. He doesn't even have his commerce chief in place. We're still waiting for his entire cabinet to get confirmed. But I think what is so important about it is potentially you'll hear more about this, because Saturday is that date he at least marked on the calendar.
Also, not going into detail works for him, right? Because the broader the threat, the broader the concessions he might be able to ring as well.
And we saw that over the weekend with Colombia.
Absolutely. Something else that is not getting perhaps as much attention is how Trump paused all federal spending on loans and grants. And this seems to apply to things like non-government organizations, foreign aid, DEI. I mean, it's the whole gamut, really.
I think a lot of this is that this administration promised to come in and review what had been done over the past 4 years. I think that's what they're doing now, putting a pause on everything till they get all their people in place. And then potentially we could see some more of these loans and grants come back out. But yeah, at the moment, all of that is stopped. But potentially, I would say, just watch this space.
All right, Anne-Marie, that's a good place to leave it. Great to see you. Of course, that is Bloomberg's Anne-Marie Hordern, our chief political correspondent. And let's broaden out this conversation now with Emily Bowersock-Hill. She is CEO and founding partner of Bowersock Capital. And what we also heard from President Donald Trump yesterday was that the release of DeepSeek AI should be a wake-up call for American tech companies. And you write in your notes that this AI reckoning that we saw on Monday was overdue. If that's the case, do you think that we're through it, or is there still more pain to come?
Well, frankly, I'm still processing it. I think if China has truly learned to develop a powerful AI model with a fraction of the budget and much less infrastructure, that would be a pretty significant shock. You know, I think I heard out of the corner of my ear on Bloomberg yesterday, and I apologize, I don't remember the person's name, but he was talking about it would be like a big pharma company who had spent billions on R&D, suddenly having a competitor come along and manufacture the same drug at a fraction of the cost. But at this time, we have no patents. So I do think this is something that the market is gonna have to digest. You know, I hope it's a speed bump. Certainly, we're still gonna get a significant productivity boost, in my opinion, from AI. So it's really the chip makers and the equipment makers that are going to struggle. But I think the market's going to have to process this.
Yeah, I appreciate your being candid about that, about something that the market needs to process. It's not just a one-day knee-jerk reaction. How does this color your interpretation of the earnings that we're going to get this week from the big tech companies, from Meta to Microsoft to Tesla?
Well, I think there's going to be even more scrutiny on them. You know, with the exception of Apple, we expect big tech earnings this week to fall in line with expectations. And, you know, before yesterday, Apple had dropped 11% year to date. We saw both Meta and Apple actually up yesterday, as you pointed out earlier in this show. So, you know, I think given the high valuations of mega cap tech, I would certainly not expect a price boost from earnings unless we see, you know, some kind of significant earnings surprise. I think we just have to hope that we get through without some sort of unexpected negative news.
Can we talk a little bit more about Apple? So you're expecting big tech earnings fall in line with the exception of Apple. Is that to the upside or the downside for Apple? Because Apple certainly has had a brutal start to 2025.
Brutal. I would expect if there's a surprise, it's probably going to be a downside surprise just because of all the issues they have with China and competition from various Chinese smartphone producers. And so I think, you know, Apple has been seen as a defensive stock, and it's the go-to when, you know, people are scared, as we saw yesterday. So I think we could get a negative surprise from Apple. But I think, you know, again, some of that is baked in already. That's why Apple was down over 10% year to date. Is that's known.
That's known, yeah. So these are all things that are going to play out over time. And I think about how General Motors gave an outlook that was not incorporating the potential tariffs. And I guess they can't really say anything because nothing has been explicitly pledged just yet. How helpful is it to hear company executives talk about the known unknowns, but not be able to put any fine numbers to it?
You know, I think it's tough. Global stock markets have not yet priced in the impact of tariffs, in our opinion, and that's because the policy particulars are still unclear. And also, it's extremely complex. You know, we haven't really seen the market react to tariff threats. We've seen reactions in the currency markets. We've seen some reaction in the bond market. But I think, frankly, at this point, until we have some more specific policies, it's very difficult to be candid about that. Who knows?
All right, Emily Barasak, we are having some communication issues here. Let's leave it right there right now with Emily Barasak joining us here on the market, CEO and founding partner of Barasak Capital. Let's get a look at some of the individual stocks that are currently moving ahead of the opening bell right now and bring in Bloomberg's Isabel Lee. Isabel, a lot of earnings that we got this morning.
Definitely a lot. And looking at Boeing, so shares are now edging flat, but this is interesting because we have the CEO, Kelly Ortberg, saying a recovery plan is in place. And this comes after the company posted its 6th consecutive annual loss. So we know that Boeing burned through some $14 billion of free cash during a really challenging year. It's been marked by near catastrophes, leadership turmoil, federal investigations, and lengthy worker strike. The CEO actually was a longtime aerospace executive who Boeing hired out of retirement over the summer. And it's made progress, but that will take time, of course. In Royal Caribbean, it's up around 4.5%, at least in pre-market trading. The company reported adjusted EPS that beat analyst estimates and extended its streak of quarterly profit. So the firm said its busiest season is looking good. It's called wave season. And wave season is when cruise promotions peak, and that's during the first quarter. So people are definitely back cruising. And they also have an initial order of 10 river ships. So that's a luxury cruise. That's their new thing. So that might catch some excitement. And lastly, we're ending on a slightly down to flat note. AMD is edging a little bit lower, down by 0.03%. The stock is downgraded to hold at Melius Research. The company sees earning risks given competition with NVIDIA. And the firm has a 2-year price target of $129 for the stock, but that's down from $160. So that's 3 I'm looking at, Scarlett and Katie.
All right, Isabel, great roundup as always. We'll see you a little bit later in the show. And let's take a look at these markets right now. Less than 20 minutes to go until the bells ring. You can see still some green on the screen, but even from when we checked markets 10 minutes ago, some of those gains coming in right now. The S&P 500, the NASDAQ 100 up about 0.1%. The Russell 2000 actually lower on the day. It was your relative outperformer yesterday, but that even is a generous term given how brutal the sell-off was yesterday. And Scarlett, it was interesting. I mean, this time yesterday, we were talking about how there's a lot of daylight between the open and the close, and that maybe we could see a rebound by the end of the day, but You were on the close and it didn't happen.
Well, we did see a rebound in things like the Dow Jones Industrial Average, which is price weighted, so it's not as accurate a reflection of the overall market.
We ignore that on the show.
I noticed that it wasn't on your market, Jack. But it's interesting that today, when you look at futures, Dow futures are lower. So a little bit of a reversal from yesterday's trade. Worth mentioning as well that today is day one of the FOMC. We're not going to get anything out of them today, but even tomorrow when they come out with their decision, the decision is no change in interest rates. It's how Jay Powell talks about inflation that matters.
That's true. That's true. Of course, there's what happens at 2 p.m. and then the real trade comes through once Jay Powell actually starts speaking. Much more ahead, though. We're going to talk about NVIDIA bouncing back in pre-market trading, but still a ways to go to recover from yesterday's DeepSeek-fueled drop. It fell 17% yesterday alone. More next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but you can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, I think we're
do it for fun.
Ready? Go.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tomorrow, the Fed decides.
The Federal Reserve has gone from projecting 4 cuts in 2025 to just 2.
The road may be bumpier than folks thought.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
How divorced can you say you are from the global market? How much can you talk about American exceptionalism?
This is not a snooze fest. There's a lot going on here.
Could not agree more.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
Now to high interest, it's a look at what's making headlines around the world. Scott Bessent has been confirmed as the next U.S. Treasury Secretary. He won confirmation in a Senate vote that went 68 to 29 in his favor, including support from 15 Democrats. The former hedge fund manager's policy objectives include 3% GDP growth, and reports indicate that he wants to start universal tariffs on U.S. imports at 2.5%. Now, an internal memo to staff, HSBC says it will wind down some of its investment banking operations in Europe and the Americas. Instead, HSBC will focus more on Asia and the Middle East. It's part of the CEO's ongoing restructuring of the lender. An HSBC spokesperson did confirm the contents of the memo. And billionaire investor Ray Dalio says today's AI frenzy looks a lot like the dot-com surge of the new millennium. The founder of Bridgewater Associates telling the Financial Times pricing has gotten to levels which are high at the same time as there's an interest rate risk, and that combination could prick the bubble. The NASDAQ 100 doubled in 1999 before falling 80% in 2002. The same index has again doubled since the start of 2023. All right, let's get you a check on the pre-market AI trade right now. NVIDIA recouping some of its losses after shedding $500 billion in value yesterday. DeepSeek's release of its AI model has forced a re-evaluation, I should say, of the economics of building AI, with some arguing that the focus should shift from spending heavily to developing more efficient techniques. Bloomberg Intelligence senior analyst Mandeep Singh is here. Mandeep, clearly DeepSeek is causing a rethink here, but is it still too early to determine winners from losers? When we saw Meta, for instance, rise and Apple rise yesterday, is that people determining winners versus losers versus just, trying to find some shelter from the immediate fallout?
Yeah, I think the theme of generative AI and building large language models is still intact. I mean, you will still see a lot of money flow into it. But the question remains, where are the scaling laws going to hold? And will the focus shift towards algorithms now, given what DeepSeek has shown is really, you can use algorithms to build a more efficient model when it comes to utilizing your hardware. I mean, for the last 6 months, it was about just how big of a cluster can you build? Will the next version of the model have more parameters? And just scaling it through hardware. Now that brute force approach will probably go away. It's more about, can you come up with a better algorithm to use the tokens in a way where the query is more efficient, the pricing per token is more efficient, and just utilize your hardware more efficiently. So I still think everyone wants to deploy generative AI. This has just shifted the focus away from, the chip makers and the scaling of data centers to more applications and really making it cheap for those guys to deploy generative AI at scale.
Well, I love that you call it, this brute force approach, because up until Friday, it felt like it was just a contest of how much money could these big tech giants spend and devote in terms of their CapEx. But talk to us about what this means going forward, not just necessarily DeepSeek's AI model, but what it represents in terms of how some of these companies, how the OpenAIs of the world are going to approach how they build out their models.
I mean, I expect OpenAI will open source at least some of their models. Just looking at how successful DeepSeek is in terms of, getting all the attention and the fact that their training run costed $6 million. I mean, it's in OpenAI's interest that the world uses their model. How do you really spread your ecosystem and really make sure that everyone is using their model? You make it open source. That's what Meta Llama did. I mean, obviously, they were not at parity with OpenAI and Anthropic Claude models for a while. But what DeepSeek is saying is you can be innovative with your architecture and come up with better pricing. And that way you can open source your model and find other ways to monetize it. But clearly, that LLM layer will get commoditized slowly. That's the message here, given what we are seeing with DeepSeek.
So Katie mentioned the big CapEx that's being devoted to building out AI. $65 billion for Meta this year, about $80 billion from Microsoft this year. Are those still the right numbers to be looking at? I mean, are they going to start updating that or tweaking that, or at least even talking about tweaking those numbers given what we've seen with DeepSeek?
So what I want to know is how much do they want to spend on training versus inferencing? Because right now, everyone thought the next training run for GPT-5 is going to cost $1 billion. For Meta Llama, it's going to cost close to $1 billion. This is just training the LLM. Inferencing is where you deploy it in applications, and that's where everyone wanted the latest NVIDIA GPUs because you want to train your LLM with the latest chips. Now suddenly the focus has shifted to inferencing because you can do a lot more with your existing chip infrastructure. So the numbers for this year still look good. My question is more around 2026 and 2027, given AI will really scale. I mean, we know this will get deployed across applications, but do these companies need to really invest in the cutting edge GPUs and really buy the scale that they were allocating right now? Probably not. And I think that's what we'll find out with the earnings season when these companies report their results.
Just to finish on the competitive landscape, I thought it was interesting to see Sam Altman, of course, of OpenAI tweet yesterday, quote, "We will obviously deliver much better models and Also, it's legit invigorating to have a new competitor. Those are his words, not mine. I just thought, I mean, what else could he say at that point? But we heard from Donald Trump yesterday, too, saying that this should be a wake-up call for U.S. firms. Do you think that it is, or do you think that some of this management is trying to talk down maybe some of the impact here?
I mean, everyone has acknowledged this, and I go back to, you know, the Project Stargate announcement, $100 billion with outside investments from Masa and, you know, SoftBank. It was, a lot of it was going towards training the next version of the LLMs. Now they have to decide, do they spend so much money upfront? Or they invest more in, you know, test time compute and inferencing, because that's what I think DeepSeek has shown. Companies can do more with inferencing than they need to do in pre-training. And I think that debate is, to me, is crucial in terms of how the CapEx gets allocated going forward.
Well, I'm sure you can't wait for some of those earnings calls to start to roll in. Pretty exciting stuff. Mandeep Singh of Bloomberg Intelligence, just a masterclass this week. And coming up, Nassim Taleb tells us that the NVIDIA rout is only the beginning. More on his remarks later this hour. This is Bloomberg.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
All right, welcome back to Open Interest. A quick check on where we stand. Of course, minutes away from the opening bell. You can see, again, that lift in markets. It's tepid, but it's there. The S&P 500, the NASDAQ 100 higher by about 0.2%. It certainly helps that NVIDIA is currently more than 3% higher in the pre-market. The Russell 2000 trying to decide what to do on your small cap index, currently unchanged, but again, trading hasn't even started. And with less than 4 minutes until the opening bell, stick with us. We'll discuss the market moves with Ben Laidler. That conversation coming up next. This is Bloomberg.
also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you were the first woman, as I understand it, first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
All right, we are moments away from the start of trading on this Tuesday. Welcome back to Open Interest. I'm Katie Greifeld, and of course, we're looking at a much different picture in the immediate pre-market than we were 24 hours ago at this time, when that DeepSeek news really sent shockwaves through the entire tech, AI, and chipmaker complex. You can see green on the screen behind me right now. Investors choosing to buy the dip yesterday in a big way. You can see that in the ETF flows really across the board. Now the question becomes, of course, do you fade this bid, or do you keep hoping that momentum will return to this market? A lot of big questions facing investors right now as we head into earnings and we head into the Fed tomorrow, of course. Maybe a little bit of a forgotten catalyst given all the drama that we've seen this week already. But about 22 seconds into the trading session, you can see that the bells are ringing down at the NASDAQ, down at the New York Stock Exchange. Plenty of enthusiasm there, and a little bit of enthusiasm as it comes to the first 32 seconds of the trading day. The S&P 500 higher by about 0.2%. Big tech trying to lead the way here, currently up about 0.3% on the NASDAQ 100, but wavering around. A lot of that is thanks to NVIDIA. I will get to that in a second, but pour one out for the small caps here, trying their darndest to get in on the action as well. They were the relative outperformer yesterday, but it was just an absolute bath across the board. But for at least for the Russell 2000, at least for right now, higher by about 0.2%. Let's take a look under the hood here and take a look at the chip makers, because NVIDIA, Micron, and Broadcom all rebounding right now after a brutal session yesterday. Traders really focusing in on big tech earnings now, and any news we might get about AI spending strategies when Tesla, Meta, and Microsoft all report tomorrow. Scarlett, it's going to be a fun one.
It's going to be a fun one indeed. All right, let's talk about some non-tech names. General Motors giving a better profit forecast than many on Wall Street had expected, but the outlook does not account for potential tariffs on goods made in Canada and Mexico. The car maker does say it is preparing for any tariff surprises. And JetBlue reporting a smaller than expected loss for last quarter. The stock currently down 17% in early trade, but its forward guidance disappointing. JetBlue anticipates operating fewer flights in the first 3 months of the year as that turnaround effort continues. But the main story, of course, today is the volatility we're seeing in the tech sector, at least at the start of the week. Bloomberg Technology co-host Caroline Hyde is here now to discuss. And Caroline, it was all about seeking shelter, seeking some kind of safe haven from the DeepSeek news yesterday. And I guess investors kind of found it in Meta as well as Apple. What is the safe haven here within tech? Certainly away from chip makers, isn't it?
It feels as though software suddenly becomes
the beneficiary of AI getting cheaper and cheaper, and the hardware infrastructure is a key question. Look, I'm surprised at how little NVIDIA is rallying right now. We're clawing back about $68 billion in market capitalization when it lost more than $600 billion in market cap yesterday. So clearly people are still sensitive to the idea that DeepSeek is managing to, with lower grade chips, yes, still NVIDIA chips, but not the H100s that we also used to here in the United States, managing to create deeply effective, efficient, powerful models are one. In fact, DeepSeek's just dropped an image generator as well, so the narrative just continues here. And I think though Meta was a key outperformer, not only because I think this is going to help in terms of their advertising models, generative AI gets cheaper, they can do more with less, but also they've led the way when it comes to open source model creation as well. So that also steals a march for them a little bit in terms of the narrative.
I agree with you on NVIDIA. I mean, we spoke to CJ Muse over at Cantor Fitzgerald yesterday, who is in NVIDIA bull, to be fair, but his point was basically that this is all good news for NVIDIA because AGI is closer. It's not further, but in any case, of course, we're sitting at the precipice of really the heart of earnings season. We have a ton coming up in the next couple days, including Apple on Thursday. What do you think that people really will be listening for on the earnings calls? It feels like it's all we're talking about.
CapEx, CapEx, CapEx. How much are you spending? And I don't think you're going to hear them backing away. Microsoft has said they're committing $80 billion in terms of data center spend. Now, you're going to hear a lot about Jevons paradox suddenly, this idea that more efficient you get about coal and basically the fact that we got more trains, more efficiency, but you still needed more coal. The more efficient AI becomes, the more data centers you're still ultimately going to need. This was also what we heard from ultimately a spokesperson coming from NVIDIA. They were saying, look, this is good for us because it's not all about training your models that, yes, clearly R1 was very cheap at doing. It's about inference here. It's about using the models. We just saw yesterday, perhaps there was a crackdown in terms of some sort of malicious attack on DeepSeek and why you couldn't sign up to it. But maybe it's also they didn't have enough cloud provision, and then also to get the answers to your questions, you need a lot of data centers and compute. So this is still the argument coming from Jensen and the likes from NVIDIA, and indeed you'll hear it from Microsoft. The cheaper it gets, the more efficient it gets, the more you and I use it, the more we're going to need compute.
It's just more good news as far as Jensen Huang is concerned. Is he on the calendar, to do anything, speak at any conference anytime soon? Because I know his earnings doesn't come till much later in the cycle, but whatever he says right now is going to be top of mind and steal the focus from everyone else.
February 26th, we've got to wait for their numbers. And that's always the way, and that's why this week we start to try and read the tea leaves. What is Satya going to be saying? And of course, Amy Hood, the CFO, going to be saying about their spend on data centers, on GPUs. What is Amazon going to be saying? What is Microsoft, as I just mentioned, going to be saying? What's Meta going to be saying? And their commitment to $65 billion, and how much of that spend is about GPUs coming from NVIDIA. I think we managed to draw out that if they remain committed to CapEx, so too NVIDIA continues to win in the short term. This is a longer term train that we're going to have to be navigating.
All right, Caroline, great to see you, of course. Caroline Hyde, she is the co-anchor of Bloomberg Technology. That's at 11 a.m. Eastern. It's a must-watch show in any case, but especially this week, given all of the drama that we're seeing in the tech sector. Let's take a quick beat on Starbucks here. Starbucks reporting after the bell today, but we have some news out from CEO Brian Niccol working to reinvigorate sales at the company and replacing two top executives. The president of North America and the chief supply and customer solutions officer are leaving Starbucks. This is according to a statement today. And again, we're looking ahead to earnings after the bell. And Starbucks, of course, has been a very tough story.
It's been a tough story. It's in turnaround mode, and Brian Niccol is starting with the little things, right? Making sure that customers who are in store get a ceramic mug as opposed to a disposable cup, trying to make sure that the store personnel greet customers when they come in, ask them if everything's okay. There's a lot of Q&A and surveys with customers. So he's getting the small stuff right, making sure that Starbucks remains a hospitable place for customers before moving to tackle some of the big strategy issues. Investors are giving him quite a bit of space to do all that, but at some point they're going to want to see results.
That's true. I mean, a lot of hopes and dreams pinned on Niccol given the job that he did at Chipotle, but we'll see how long that patience lasts. But let's broaden out now and welcome in Ben Liedler. He is Bradesco Securities Head of Equity Strategy. And I won't ask you about your Starbucks order, but I am interested about what happened yesterday and what your read of was when you think about DeepSeek, their cheaper AI model, and all of the question marks that are around these big CapEx plans from a lot of the U.S. tech giants. Did anything fundamental change for you yesterday?
Well, the market certainly gave itself a collective heart attack. It's not every day you see 30 large caps down 10% or more. But your point, I think this tells us more about crowding and more about the high valuations in some bits of the US than it really does, about the fundamentals. I mean, this has been a sort of one-way freight train for a couple of years now. It's sucked in an awful lot of capital. It's taken valuations to quite high levels. I don't have a problem with them, but they are objectively high. And I think we had a little bit of a reality check yesterday that, maybe tech disruption is not a one-way street, but I don't think the fundamentals have maybe decisively changed for big tech.
Yeah, it's a great point. Maybe the fundamentals didn't change, but certainly the valuations under a microscope right now. And with valuations, it always feels like they don't matter until they do. And yesterday, they certainly mattered. Do you think that they will continue to matter in this market? Is there more pain, more indigestion to come?
Listen, I think big tech is fine, but I think the real opportunity is everywhere else. And our narrative has really been this bull market broadening out. It's been a bit of a one-legged stool so far. It's all been about the Magnificent Seven and the broader tech sector. I thought it was very interesting yesterday that value, you mentioned small cap, rest of the world, they really picked up the baton. I think that's extraordinarily healthy. I think a little bit of interest, a little bit of money will go a very, very long way in some of these other assets. They've got very small and very cheap, but I do think they are the sort of canary in the coal mine for a healthy broadening of this bull market.
Yeah, people talk about that a lot, this broadening out, and finally, perhaps we're seeing it with some distress coming to tech first. I look at the VIX, currently below 18 after surpassing 22 yesterday. Still, at yesterday's close, it was the high since the December 18th Fed decision that sparked that big sell-off. Feels like volatility is the new normal now. Is the volatility a good thing for a stock picker?
Oh, I think so, and 20 is basically your long-term average. So it's taken us a few years to get here, but this is what we were used to living with until the last few years. And I think the combination of the fact that big tech may not be a one-way train anymore, the new administration, the potential threat of tariffs, which we may get as soon as Monday. We have a Fed meeting. I can go on and on and on. And there's plenty of reasons, I think, for this new normal, which I think is absolutely right, of stock market volatility.
All right, speaking of the Fed, Jay Powell, will be taking the lectern tomorrow at 2:30 p.m. We know his comments last time around did spark a decline in asset prices. What will you be listening for when it comes to anything he betrays on inflation? Because obviously he's hamstrung by the fact that there's not a whole lot of policy to respond to so far, right? There's a lot of general vague threats about tariffs, but no details to really work your way into models.
I think he's going to try and take a punt. The latest inflation number has been, reasonably, benign. There's obviously a lot of macro uncertainty, ahead of us. I think he'll try and give a sort of open-ended statement. But I think, the market's already moved quite aggressively, I think, to pricing, basically no more cuts or maybe one more cut. But I think the risks are elsewhere. It's this one-legged stool of big tech. It's potential tariffs coming on the rest of the world. It's that policy mix. I think for once, and touch wood, I think the Fed will take a back seat here.
Well, Ben, that's where I wanted to go. Basically, what are the catalysts of this market? Touch wood, like you said, the Fed seems to have taken a back seat. But, I mean, if we start to really reassess that rate cut picture, I mean, could that overwhelm what we're talking about when it comes to politics, when it comes to earnings season as well?
I think ultimately this comes back to earnings. It's what we know now. We're on track for the best earnings season in the US in a couple of years. Earnings are accelerating. Earnings are broadening out. Margins are remaining, extraordinarily resilient. I think that is the focus. It's going to take quite a lot of other stuff, I think, to really push that off track.
All right, Ben Laidler, thank you so much for joining us. Ben Laidler with Bradesco, giving us an outlook into what we can anticipate, earnings driving everything. Coming up, speaking of earnings, GM tops profit estimates, but the stock slumping more than 8.5%. We take a look under the hood next. This is Bloomberg.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race. And Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Roper Technologies upgraded to buy from hold over at TD Cowen. The analyst says that the software firm's U.S.-centric portfolio could be attractive to investors. Next up, we have Barclays upgrading Victoria's Secret to overweight, saying they have confidence that the new CEO is the right choice to lead the lingerie company's brand revival. Shares up almost 4%. And finally, let's end with Ciena, raised to overweight over at JP Morgan. The analyst is saying that yesterday's sell-off of the communications tech company offers an entry point into better near to medium-term momentum. And another stock we're keeping a close eye on this morning is, of course, General Motors. The stock falling sharply after this morning's earnings report, even though the automaker announced better than expected profits in the futures, but it did not take potential tariffs into account. Here with more, I'm pleased to say we have Bloomberg's Detroit Bureau Chief, David Welch. So tariffs feels like a pretty big thing to leave out, David. Did we hear anything more in terms of detail on the earnings call?
What they said is they have contingency plans, they have things that they can do. They didn't give a lot of detail on that, and I think that's what investors are reacting to. General Motors gets about 22% of its U.S. sales from vehicles built in Mexico, and they've got pickup truck plants. It's its most profitable vehicle line. They've got them in the U.S., of course, but they have a plant in Mexico, another one in Canada. So you're talking about volume on their most profitable, highest volume vehicles potentially being subject to tariffs. And all of that kind of gives a potentially cloudy future here for earnings for the next few quarters until this whole tariff situation between the Trump administration and the other USMCA countries gets ironed out. So you have that really hanging over the stock. And the other thing is the upgrade on the high end was an addition of about $700 million in operating profit this year. That's very good, but most of that, $500 million of it, came from the elimination of Cruise. That tells you that the rest of the business is solid. You're seeing improvement in China. You're seeing strong pricing and good sales in the U.S., but it's not enough to overcome these other potential headwinds here. And it just shows that their core business is stable, growing a bit, pretty good, pretty solid. But who knows what's going to happen with tariffs? And that's got everybody on edge right now.
Yeah, it leaves GM in an unenviable position, which is the things that it can control, it's doing, it's executing on, but there's too much that's, really left to Washington and what may come, and it really has no ability to manage any of that. Having said that, what does the business look like on the whole in the United States, which is, of course, now that it is improving in China and recovering a bit there, the U.S. remains its biggest market?
It is, and in the U.S., GM has kept up pricing in the fourth quarter. Sales were up 21%. Those are all good things. Some of their competitors are discounting in the U.S., adding rebates. They've been able to avoid that so far, and they think they can for a while, although they're acknowledging that they could see some price pressure this year. The other good news for them is they're starting to mitigate losses, and in fact, getting to variable profitability on their electric vehicle program. But there, too, they say that the biggest drivers of reducing losses and getting to a operating profit on the electric vehicles is scale. That means more sales. And if the Trump administration gets rid of or at least greatly reduces the tax incentives, that again, that's another issue that could be a headwind for GM this year. They'll probably still grow sales in their EVs. They'll continue to get scale, but it could slow down their march toward making that a totally profitable program.
All right, David, appreciate your reporting. Of course, that is Bloomberg's David Welch on a terrible day for General Motors, currently down about 8.5%. It was one of the automaker's standouts last year, but can't say the same today. Let's check in on Boeing quickly, though. Of course, they reported earnings this morning. You can see shares flying on a relative basis relative to Boeing's recent history, up about 4% right now, actually foregoing setting financial targets for 2025. But we did hear from new CEO Kelly Ortberg saying that he's optimistic about returning to a production rate of 38 737 aircraft per month this year. Scarlett, talk about a turnaround story. This is one that investors have been watching super closely.
Yeah, 6 years of losses over at Boeing. This is clearly a long-term turnaround story. Nothing's going to happen right away. And even to that end, with Kelly Ortberg addressing these needs to invest in core businesses, perhaps, paring down the unprofitable businesses. He's not saying a whole lot of detail on that. It's still a work in progress here. And the big question is what happens with demand for the jets? And that is a good news story because there's not enough supply of these jets.
No, not at all. So we'll continue to follow that one. Just one of the many things that we're keeping an eye on.
All right, coming up, we've got Nassim Taleb saying NVIDIA could see further losses 2 or 3 times what we saw yesterday. That was a 17% plunge. We've got more in our Wall Street Beat. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Time now for the Wall Street Beat. Black Swan author Nassim Taleb says the steep sell-off in NVIDIA shares yesterday exposes the market's reliance on a few names, and he warned of more losses ahead. Look at NVIDIA right now, Katie. Unchanged. It had opened and gained as much as 3.2%, but it's now teetering around, so this recovery that we're anticipating may not come to fruition.
Yeah, it's pretty nerve-wracking here, and I don't know, maybe it adds some weight to what Nassim Taleb is saying here in terms of more losses ahead. He, of course, spoke with Sonali Basak on the sidelines of Miami Hedge Fund Week.
NVIDIA went up from something like 12, 13, 14, 18, all right? Went up an order of magnitude. So giving back 17% is not large. It's just a small setback.
Why do you think it was such a sharp sell-off? Was it market structure and too overcrowdedness in one name? Or was it the
everybody
fundamentals?
focuses on the same story, and people notice the falls more than the rises, okay? They found it natural that the story would work, that NVIDIA would keep rising, and unnatural when it pulls back a little bit. It pulled back, very little considering the risks involved in such an industry. You're building everything on the hope that people will use your chip, will use chips, Royal chips, and that the investment will not come from software or someone figuring out a better idea or some other method, which is what happened. It's a hint of what is to come.
Well, are you saying that there could be a lot more in terms of a drawdown?
I think that the over-reliance on that story of, number one, you're going to be the one making money from AI, NVIDIA, not others. This over-reliance is completely at odds with our knowledge of history, all right? The one who came up with the first laptop computer, Sir Clive Osborne, went bankrupt. Okay, the one who, look at history. Those who come up with a new technology, they think, hey, you know what? We figured out this. It's going to be the future. We own the future. And sure enough, okay, someone else will make the money.
All right, that was Nassim Taleb speaking with Sonali Basak in a very Miami setting. Of course, the music and the setting didn't quite match up with what he was saying because it was pretty doom and gloom when it comes to what we could see in terms of more pain on this NVIDIA story.
Yeah, he felt very comfortable sitting there, in the Miami heat with the jolly music talking about what he expects. He calls tech firms gray swans because investors underestimate the possibility of one-day deviations in their prices of the likes that we saw yesterday in NVIDIA. $589 billion in market cap lost just in one day.
And gray swan seems generous from him because a lot of people were saying that yesterday was the black swan moment for AI. It wasn't even something that a lot of people had on their dance card. We heard from Ruth Porat over at Davos last week saying that China was maybe a year off from American AI models or something to that effect, and maybe even that timeline is is being questioned right now. We'll continue to follow, of course, what's going on in the market, what's going on with NVIDIA, trying to decide whether it wants to go higher or lower right now. You can see the S&P 500 taking a leg lower, down about 0.1%. The NASDAQ 100 trying to hold on to gains. Stick with us. Coming up in our next hour, we'll speak with Grace Peters. She is JP Morgan Private Bank Global Head of Investment Strategy. This is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of science. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. The new Homeland Security Secretary, Kristi Noem, rode along with federal immigration agents and posted video as they staged raids on undocumented immigrants suspected of criminal activity in New York City. CBS New York's Christina Fan says they made at least one arrest.
You can see law enforcement officers carrying out the enforcement operation at an undisclosed location. We're told the suspect, now in custody, whom the DEA blurred in these photos, is facing charges of kidnapping, assault, and burglary.
The Trump administration has just ordered a pause on federal grants and loans. CBS's Nancy Cordes.
The White House appears to be calling on all agencies to impose a spending freeze on federal assistance by 5 p.m. today.
Business analyst Jill Schlesinger.
Because there weren't a lot of details, organizations ranging from those focused on medical research to food assistance to funding suicide hotlines have now been thrown into turmoil, trying to gauge whether or not they will be impacted.
Michigan Senator Gary Peters, who led the Democrat Senate campaign efforts over the last 2 election cycles, has made a surprise announcement. He will not seek re-election. After losing the presidential race, it forces Democrats to defend a critical seat in the GOP-controlled Senate without the advantage of an incumbent. One name being bandied about, former Transportation Secretary Pete Buttigieg. CBS's Jim Krasula now with an update on a financial settlement in a disastrous train derailment in eastern Ohio.
The village of East Palestine and the Norfolk Southern Railroad have announced a $22 million agreement to settle all of the village's financial claims from a 2023 train derailment near the Ohio-Pennsylvania border. The railroad has already paid the town more than $13 million to clean up toxic soil that resulted from the accident.
Tech stocks slightly higher a day after China's artificial intelligence startup turned Wall Street upside down, disrupting America's plans for AI dominance. CBS's Kelly O'Grady.
DeepSeek is saying that this costs less than $6 million to make. You compare that to $100 million to $1 billion for the comparable U.S. models. And it's also more energy efficient. It used just about 2,000 chips versus tens of thousands.
NASDAQ up right now more than 1%. Strong profits and record profit sharing at GM. Here's WWJ's Jeff Gilbert.
GM's bottom line was impacted by big costs in China, but profit sharing is based on North American earnings.
And Chief Financial Officer Paul Jacobson says that means checks of up to $14,500.
When we deliver results like these, everybody wins, including our employees.
The S&P.
Forster and the Ad Council.
That's NVIDIA stock now up 1.5%. And there are new bird flu concerns as egg prices continue to rise.
Health officials say a different and rare strain of the bird flu virus has been found on a duck farm in California. Since 2022, 145 million chickens, turkeys, and other birds have been killed to stop the spread of bird flu. Laura Burnell manages a cafe in Southern California.
Our eggs went from $19 a case to $160 right now. $160 a case.
That cafe uses up to 7 cases a day. The USDA predicts the cost of eggs will go up by another 20% this year. Steve Kathan, CBS News.
New trouble for an NBA star. CBS News has learned the Miami Heat are suspending forward Jimmy Butler for walking out of a shoot-around before yesterday's game against the Magic. It's his 3rd suspension this year. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from Lower Manhattan. Alex Steele, Paul Sweeney with you here, the Bloomberg Intelligence Program. We are at the offices of BAM Mutual, Build America Mutual. These are the good folks that insure municipal bonds and make sure that that important market remains healthy and robust. So we're going to have a lot of smart guests here from the offices of BAM Mutual talking a lot about municipal bonds. So we'll stay on top of that for the next couple hours. We appreciate their hospitality here. But we've also got earnings out. We've got some economic data. Consumer confidence came in a little bit weaker. We'll break that down in just a moment. But we're going to talk to some smart muni bond folks coming up here. Peter DeGroot, head of municipal research at JP Morgan. He's going to join us here as well. Tom Doe, founder and CEO of Municipal Market Analytics. So we're going to get your fill of municipal bonds.
Oh, yeah. I'm going to have more than 1 or 2 questions, I promise. Taking a look here at the consumer confidence number, Paul, that you just referenced, it unexpectedly fell in January to a 4-month low. And the reason, the labor market and the outlook for the broader economy. So let's go and get more on this right now with Stephanie Gouchard, senior economist at the Conference Board. Can you walk us through this lack of confidence, Stephanie?
So I wouldn't call it a lack of confidence. True, our index declined for the 2nd consecutive month. However, if you look at it for the past 2 years, it's been stuck in this narrow range, and it's not breaking free, nor on the upside, nor on the downside. So indeed, this month there was a decline, but it's more like a correction from the very strong index we saw in October and November. So to us, it's just a correction, and it's driven by consumers' assessments of the present situation, which has been downgraded slightly.
What's historically for this measurement, Stephanie, what's kind of the key drivers for consumer sentiment here? What's really been kind of pushing this over the last year or two?
I think it's really the labor market. So for the past 2 years, consumers have been very happy with the current situation on the labor market. I mean, we all know employment has been relatively low. There are plenty of jobs, a bit less than just after the pandemic, but still plenty of jobs available. So consumers are happy about the present situation. They are worried about the future because they all know that good things don't last forever. So you have these two drivers, happy about the current labor market, worried about where it's going. And this has been really driving our index for the past 2 years.
All right, Stephanie, we appreciate that. Thank you very much. Stephanie Gisha joining us from the conference board. Thank you. All right, well, John Tucker didn't get to come down here.
Oh, I know he's crushed.
When do I get to go anywhere?
But John Tucker is here. You never get to go anywhere. It's true. You're our home base, man. John Tucker's here. He's going to give us an update on the market with the Bloomberg Business Flash.
And this Business Flash being brought to you by IBKR. Will the average U.S. temperature in January this year be greater than 34 degrees? You can trade your prediction with IBKR Forecast Trader. The yes was recently at 14%. By yes or no, and earn $1 if you're right. Go to ibkr.com/forecast. Well, a day after the DeepSeek-fueled tech sell-off, major stock averages, right now they're slightly higher, but I'm going to say also, just parenthetically, they're kind of groping for direction. And you can guess most actively traded shares of NVIDIA right now, after the 17% sell-off yesterday, those shares are up about 0.8%. And Dan Ives over at Wedbush Securities, talked to him earlier today. He calls the sell-off yesterday in shares of NVIDIA a golden buying opportunity.
I mean, sometimes sell-offs happen for reasons that are going to fundamentally change the stories. This is dramatically different because nothing is changing the $2 trillion of AI spend over the next 3 years.
NASDAQ 100 right now 70 points higher. That's up 0.3%. The S&P 500 8 points higher. That's up about 0.1% right now. It's 6,020 on the index, and the Dow Jones Industrial Average up just 57 points. That's a rise of 0.1%. Some of the individual shares also on the move. Take a look at JetBlue Airways. That is a decline right now of 22%. The company projected higher costs this year than expected. And, of course, the Fed starting its two-day policy meeting today. Traders also are going to be focusing on earnings announcements from the Mag 7 cohort, Microsoft and Apple, reporting later this week. And we check the markets for you all day long right here at Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex, I miss you guys, Alex and Paul.
Very good. We miss you too, John. We'll see you mañana. That is for sure. I will. Alex is she's jetting off somewhere, but
that's true. Just kidding.
Alex Steele and I were downtown at the offices of BAM Mutual, Lower Manhattan, World Financial Center. The kids now call it Brookfield Place. We're down here in Lower Manhattan, so we're talking municipal bonds here today. But there's a lot going on in the world, particularly as it relates to tariffs. President Trump again, kind of bringing it on the front burner here as part of his economic policy. So we want to break it down a little bit. Holly Frome, Bloomberg Intelligence litigation analyst. Holly, what do we know? What's the latest on President Trump and his tariff policy? How do you think he's going to move forward?
Well, yeah, so he's changed it from day to day. So on the campaign trail, he had pledged tariffs of around 10% to 20% on all countries' goods besides China, and China 60%. Recently, we've heard other things that he's going to impose perhaps a universal tariff, or he's going to impose tariffs on certain countries like Mexico and Canada, 25%. So he's from day to day. So we're not sure where he's going, but we do think that he's going to impose some kind of tariff.
And he has definitely said that as well. How do we distinguish between tariffs that are used as a negotiating ploy, like what we saw in Colombia over the weekend, versus some serious tariffs, like when he's talking about steel, aluminum, and copper, for example?
Right. So he has used his tariffs power as a negotiation tactic. We've seen him do this before. He did this in 2018 when he threatened to impose tariffs on Mexico to address what he's called was a border crisis, and he wound up settling that. So we saw this happen over the weekend where there was a dispute and he threatened tariffs. and he wound up settling that as well. When he talks about sector-specific tariffs, I think there's more credence in that. There's a lot more authority for him to do that in terms of statutory authority for him to do that. And that's not to say that he doesn't have authority to impose tariffs if, for example, he says there's a border crisis. It's not clear. The tariff power has not been used in that way before, so we haven't seen that sort of exact precedent. But when he talks about sector-specific tariffs, we have seen tariffs used before in that way, and they have been universally upheld. So it's you don't know if it's a negotiation tactic or if it's if he genuinely intends to oppose them.
Holly, what kind of support, I guess, within just broader Washington, broader trade community in Washington is there for tariffs, whether they be kind of surgical or more broad?
Well, it could be either. So under statutory authority, he can do either. So he could. There are various statutes he can use to impose tariffs, and they have various justifications. So to address national security issues, for example, or to protect the U.S. dollar, or to address trade deficits, or countries not abiding by trade agreements. And those could be, and if it's sort of like to address countries not abiding by trade agreements, we've seen this happen in 2018 when he did this on China, and he imposed tariffs worth of on $370 billion worth of goods from China, and there were sweeping tariffs, all kinds, thousands of goods. So it could be something like that. Nixon used one statute to impose a tariff of 10% on all dutiable goods in 1970. So that was sort of a broad, what the closest thing we have to a universal tariff, and that was upheld by the courts. So it could be either, that the statutes give him authority to do either, but it's just, will this specific tariff be upheld when the courts look at it, and that it depends. But I will say that courts have been very reluctant to overstep the tariff authority of the president. We found no case in which a tariff was struck down that was affirmed on appeal. So every tariff essentially was upheld by the courts.
So talk to us about some specific sectors, Holly, that you guys are looking at when it comes to these tariffs.
Well, for example, he's imposed tariffs on steel and aluminum. I think that's likely to happen again. We've been looking at the auto sector because he's threatened to impose tariffs on autos from Mexico and electric vehicles, for example, perhaps from China. So and it affects so many different industries. So we've looked at industries across the board because they could all be affected.
Holly, what have we heard from some of the companies that could be impacted? So, for example, General Motors just reported today, and I would think, boy, I know we import a lot of cars coming through Mexico. That would be a real impact on their business and what consumers have to pay for cars. Have we heard anything from these companies yet that kind of strikes you?
Well, I think the countries have been, the companies have been saying that it's going to increase the cost to the consumer. But then, the president comes back and says that it'll domesticate manufacturing here and then ultimately benefit the consumer. So I think that's been sort of the rallying cry of the companies who are opposed, is that, this is just going to increase costs for us, and the consumer is eventually going to, this is to the detriment of the consumer. And depending on who you ask, it's, benefit or detriment.
Yeah, but Paul, to your point, you can make an argument that one of the reasons why GM stock is getting hit so hard is because their outlook, which was better than expected, does not include any tariff threats.
Right.
So it's sort of everything is priced for perfection, and you had a Bernstein analyst said that there was no room for errors on that. So clearly that's a huge risk for some of these guys. Holly, thanks a lot. We really appreciate it. Holly she's Bloomberg Intelligence litigation analyst. Nonetheless, it looks like, are we still seeing a pop in NVIDIA? Because it feels like it wants to go higher today, that stock, after what we saw yesterday, that unbelievable rout. The stock is up by 1.5%. Call that a relief rally, considering that it lost the most market cap of any single stock ever by 2 times the amount that it had already made that record the last time.
Yeah, just extraordinary. And if you look at the list, I saw Bloomberg News had a list of the top 10 stocks in terms of market cap. I think NVIDIA's on there 8 times.
Yeah, in terms of the biggest loss, yes.
Biggest, yeah, just moves, just extraordinary.
And then you have all the superlatives, like it lost as much as Oracle's whole market cap, or Exxon as well. But now that stock is up by 1.3%, but not really making up for a lot of that. Anyway, we have a lot of great headlines coming up for you and a lot of great guests. Coming up, Harry Wilson, Bloomberg finance reporter. We're going to talk about HSBC. They're going to shutter some investment banking units in Europe and the U.S., really doubling down in the Middle East and Asia as well. Plus, Tom Doe is founder and CEO of Municipal Market Analytics. We're going to break down the muni market, what to expect, where the opportunities are, and what to think and do under President Trump administration. This is Bloomberg Intelligence from...
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. And this flash is being brought to you by IBKR. Will U.S. oil production exceed 13.61 million barrels per day for November 2024? You can trade your prediction with IBKR Forecast Trader. The yes was recently at 35%. by yes or no and earn $1 if you're right. Go to ibkr.com/forecast. The major stock averages right now, they are slightly higher after the deep-seek frenzy yesterday. Most active are shares of NVIDIA, recovering some after that 17% sell-off. It is now, right now, shares of NVIDIA up 1.7%. NVIDIA, Apple, Amazon, they are the leaders in the NASDAQ 100 in terms of index points. Also in focus, the Fed starting its two-day policy meeting today. Don't expect any changes to rate policy. Traders also focusing on earnings announcement from Microsoft and Apple, among others, later this week. The profit growth at the biggest tech companies projected to come in at the slowest pace in almost 2 years. And it's worth repeating, Alex, you said this yesterday, in the S&P 500 yesterday, rising stocks far outnumbered the declining ones. That bullish breadth amid such a big index decline, probably unprecedented in the last 20 years or so, according to Bloomberg data. Right now, the S&P 500, 24 points higher, but it's a 0.4%, 6,037 on the index. The Dow Jones Industrial Average, right now up 140 points. That's a rise of 0.3%. And the NASDAQ 100, 165 points higher. That is up 0.8%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, thanks so much, John Tucker. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from downtown Lower Manhattan for BAM Mutual. We're going to talk munis and get the take on where the analysts are looking for the huge opportunities this year after a stellar 2024. But in the meantime, we also want to update you on some of the stocks on the move and all the interesting headlines in the business world. HSBC is one of them. Now, the stock in London is trading pretty much flat, but the news behind it is quite interesting. The company is going to wind down its investment banking operations in Europe, the UK, and the Americas, focusing on Asia and the Middle East. Joining us now, Harry Wilson, Bloomberg finance reporter. Harry, was this a surprise to you?
I think that today's news is a surprise. It's something that we've probably expected that could happen over the years. The truth is that HSBC has really been nowhere on Wall Street and in the city for some years now. It's struggled to even get into the top 10 when you look at sort of major league tables like equity underwriting or M&A. So the idea that they're just now kind of giving up on this thing, realizing that they can't compete with the likes of Goldman Sachs, JP Morgan, and that actually they'd just be better off focusing their resources on markets where they do have some scale, such as Middle East and Asia, makes a lot of sense. So I guess short answer, timing wise, surprise. Longer term, no, I don't think it's particularly surprising that they're taking these actions.
So, I mean, this kind of goes to me, Harry, kind of a bigger question, which is these European banks, can any of them be global investment banks? I mean, 20 years ago, I don't think we would have seen this happen.
I think it's very difficult. European banks have faced these type of problems going back decades now. Many have tried to make some kind of impact on Wall Street, and many of them have come back having spent hundreds of millions and got really nothing for their investment. The simple fact is that Wall Street is something of a lockout by the US major firms, and even when you get the likes of, say, Barclays, which was able to buy off the peg the Lehman operations in 2008, even they've struggled to make much of it. And I guess the issue is that if even a bank like HSBC, the largest bank in Europe, can't really make this thing work, then it begs questions about how anyone else, without their type of scale, without their type of profitability, could expect to make much of an inroad.
Mm-hmm. What's the opportunity set if we flip it for Asia and Middle East for HSBC?
Obviously, these are fast-growing regions, so you've got a lot more economic activity, a lot of growth coming in Asia. You've got a lot of money in the Middle East. You know, every day we see headlines about a Middle East hedge fund being involved in some deal or another. So these are good places to be a big bank. The question really is if you don't have the operations, say, on Wall Street, in the City of London, continental Europe, how meaningful can you be to those types of clients in Asia and the Middle East when they want to do stuff around the world? You know, it's all very well, obviously, saying, you know, we're very big in Middle East and Asia and we'll service you there. But when it comes to being able to offer some kind of global perspective, maybe being somewhat lacking there. And I think that's going to be the area that's going to be interesting to watch here, is whether HSBC, if it doesn't have the stuff around the world and is purely focused on Asia and Middle East, whether that is still a good proposition to its clients that in those regions that maybe want a more worldwide global networked offering.
All right, Harry, thanks so much for joining us. Really appreciate it. Harry Wilson, Bloomberg News, talking to us about HSBC stepping back some of its investing banking activities around the world. Let's get back to the municipal market. We are at BAM Mutual offices down in Lower Manhattan, Build America Mutual, talking about the municipal bond industry. Tom Doe joined of Municipal Markets Analytics. Municipal bond market, it's an active market. Talk to us about 2024 in terms of new issuance, Tom, and kind of what you guys think about 2025.
Well, there was record issuance, as you point out, in 2024. Tremendous access to the market. We think there's going to be continued high issuance going forward. We actually think that in the next 10 years that we'll see municipal issuance reach $1 trillion a year versus $500 billion last year.
Whoa, and the buyers are all there.
Yes. And it's predominantly individuals through funds, ETFs, and in direct purchases.
Some of the Trump administration, President Trump himself, is saying that perhaps as it relates to infrastructure spending, maybe even disaster relief spending, that some of the spending should be more at the state and local level versus the federal level. How does your market think about that?
I couldn't agree more with that perspective. In fact, a year ago, almost to the day, I testified before the Senate Budget Committee and made those points. Senator Braun from Indiana, who is now governor in Indiana, championed that. I think that the states and local governments have the capacity, debt capacity, to take on, can take on more, and it's right for them to have that local oversight for the disaster relief. So I think it's a win-win. I think that we have more control at the state and local level. The federal government takes some of that responsibility off their books. So I think it's a real opportunity actually for the municipal industry. What Trump is saying in Project 2025 regarding FEMA.
What other issues out of D.C. or headlines out of D.C. are you guys in the muni market monitoring this year?
Well, the municipal market is kind of a fear-based market because everybody's looking at the exemption drives everything. And so there's a great...
As in, like, that might go away, and then therefore...
Exactly. And so everyone thinks, oh, my God, from a mutual fund manager, you'll be talking to some later today. And they go, my God, if it's not a tax-exempt market, well, what do we do with our business? I think... And who knows how to handicap that? I mean, the market's been around for 100-plus years. I think low default rates because it's retail dominated. I always remember back in 2008 that Barney Frank, during the financial crisis, said the problem was the disconnect between the borrower and the lender. And I think that's what the municipal market actually has, is that close connection because of the exemption. So there's some limitations the exemption presents, but it also creates that better oversight. And as a result, low default rates and a very attractive investment.
States, municipalities, I've been told in the municipal bond market, they issue the money when they need it, not when maybe it's smartest to raise it, like when rates are low. If they have to build a bridge or something like that, or a road, that's when they issue the bond. Is that still kind of how it works?
I think you're right. I mean, it's not a very forward-looking market. But to your point, the federal government also doesn't often borrow when rates are low, too, right? So it's not just the state and locals. So I think what I'd like to see, certainly in wake of Los Angeles and the wildfires and the hurricanes in North Carolina we all know about, is that we could have more climate adaptation type of projects. So better infrastructure for flood control, water and sewer, management of wildfires, these types of things, I think are opportunities for the municipal industry to really step forward and start pushing some of these projects.
Dumb that down for me for a second. So does that mean that then you would issue bonds that would be tax exempt, that then you'd use that for disaster prevention?
Well, sure, because in that, so let's say we know the storms, rainstorms, are we see more rain, they're more frequent, and they're overwhelming existing infrastructure. So really, what I'm saying is just saying to the forward looking is being more attentive to upgrading antiquated infrastructure that we know, the lead pipes and all this type of thing that are around. But I'm very interested in the flood and the water and sewer aspect, because I think that it impacts not only economies, it's important also on utilities to upgrade those. We've seen those with the wildfires, right, the sparks, and whether it's Hawaii or California. So I think that's the opportunity for the industry to say, well, this is a way to upgrade infrastructure, and now to reduce the potential future costs of the federal government through FEMA.
What are some of the sectors that you think will be active issuers in the coming year or 2 or 3?
Well, as I just mentioned, again, I come back, I'm on a drum beat here. Right,
how about education? Because I'm not sure, that used to be, I felt like a good active area, but I'm not sure anymore.
Well, everyone likes to build schools, right? Yeah. They're politically attractive, and it's always about the children, right? So everyone likes to do those, and that's a high percentage of municipal issuance is tied to schools, secondary and elementary and all that. So I think you'll see continue that. I again, coming back to a theme that I think is really focused is, changing weather, increased heat. You've got to improve HVAC systems in these schools in Arizona and all this. And so that's another area of financing. In Montana, there was financing for airplanes to fight wildfires.
Yeah,
it's an airplane deal.
Yeah, interesting. Yeah, we saw them in LA, certainly.
Yeah, absolutely.
What about SALT deductions? Like we're like super into looking at those. Obviously, living in Jersey and New York, how does that influence or change or impact the muni market?
Quite frank, muni market not so much.
Okay.
Really, I mean, it's more of our personal interest, right? Yours and mine of having that. So.
But so no changes in terms of the demand for municipal bonds, or okay.
No, I mean it's on the margin type of a thing.
See. Municipal bonds, I'm telling you, it's a thing.
It is a thing.
I'm telling you. I'm a big fan of the municipal bond market.
I think they're great. It's fun. It's a lot of gray area, so it makes it interesting as well, right? It's political, emotional.
The city gets out of the municipal bond underwriting business. Great strategy.
Yeah, it's
city.
Not
you got to be kidding me.
What a mistake, right? Huge mistake.
Terrible. Tom Doe, founder and CEO of Municipal Market Analytics, joining us here talking about the municipal bond market. It is a big market, active market, deep market, and Build America Mutual plays a big role in that because they insure a lot of municipal bonds, which gives investors added security and things like that. So we keep an eye on that as always. Looking at these markets here, we had some pretty nice trading early on. We got the S&P up 0.5%, the NASDAQ up a solid 1%. Yields, 10-year Treasury, 0.3%. So up 0.3%, 4.56%. So we keep an eye on that. I'll call it out for you, Alex. WTI crude oil.
Thanks.
Up about 0.4 of 1. Just at $3 per gallon at the BP station on Route 35 on in Wall Township. So keep an eye on the retail gasoline price. Bitcoin up 2%, 103,000. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, the dust may be settling a bit after Monday's AI reckoning. After that sell-off that shook markets around the globe, the stock averages right now, they are pushing higher. You have the NVIDIA shares. They are climbing 2.4% right now, rebounding some after suffering its biggest value loss in history yesterday. And Peter Oppenheimer at Goldman Sachs says Monday's DeepSeek-inspired sell-off doesn't fundamentally change the outlook for stocks.
We shouldn't lose focus on the fact that the global economy, and the US in particular, remains pretty robust, and interest rates are coming down, and those underlying foundations that we think are still pretty supportive for the market and indeed the tech sector.
Right now, the NASDAQ 100 is up 190 points. That is a rise of 0.9%. S&P 500 up 0.5%, 32 points higher at 6,045. And the Dow Jones Industrial Average 184 points higher. That's a rise of 0.4%. Two-year yield up a basis point. The 10-year yield, 3 basis points higher. That's right now at 456. Next up, the big tech reporting period kicks off. That's tomorrow. Our earnings, so-called Magnificent Seven, still rising, but analysts anticipate a marked slowdown in growth relative to the prior quarters. Among the other individual standouts, you have JetBlue shares. Right now, they are plunging. JetBlue down over 24%. The airline delivering an outlook for the first quarter revenue that is seen as disappointing. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney. We are live from the Build America Mutual, BAM Mutual. They are located in Lower Manhattan. We're at their offices today talking about the municipal bond market, which we like to do from time to time. For those of us that live in a high-tax state like New Jersey, for example, the triple tax-free baby equivalent yield is very, very attractive. Peter DeGroot joins us, head of Muni Research for J.P. Morgan. Hey, Peter, one of the big issues, there's a lot of talk about tax reform out there. Is there ever a discussion about addressing or eliminating or adjusting the tax efficiency of municipal bonds?
First of all, thank you very much for having me here. In terms of in the municipal bond market, naturally, there is a significant amount of discussion around the potential elimination of the federal tax exemption for interest rate income on municipal bonds, right? This, as the task for Congress, is to come up with a roughly $4.6 trillion bill for the extension of TCJA. Mm-hmm. Therefore, I guess the alarm in the market started when we received a very extensive list from the House Ways and Means Committee, which included about over 100 pay-fors for potential pay-fors for that extension of TCJA. On that list were some far-flung items like the elimination of the mortgage deduction for homeowners, which pretty far-flung, right? Yep. The other, which we thought was sort of remote, is the elimination of the exemption for federal taxes on for state and local taxes on your federal tax forms, right? Along with those was the elimination of the exemption for tax-exempt interest for state and local bonds,